Interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Farrow, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Welcome back to the European Market Open. A minute to go until the start of cash equities trading. Here are your headlines. Staying vigilant, Jay Powell says the Fed is ready to take action if prices get too hot, but that it's too early to pare back stimulus. China's recovery steadies. Economic growth slows in line with forecasts as consumer spending picks up. Plus, Morgan Stanley's next on the docket for big bank earnings. How will it stack up against its Wall Street rivals? Let's take a look at futures then. Good morning, everybody. Welcome to the second hour of the European Market Open. Just 20 seconds to go until the start of our trading day here in Europe. And we've got European equity market futures pointing to the downside. As I mentioned just before the break, things looking a little bit more mixed over in the United States. Dow and E-mini futures, yes, they point lower. NASDAQ futures point 0.2% to the upside. So perhaps there's that technology disconnect once again. But here in Europe, expecting to see a little bit of weakness. We might see a few bright spots around the earnings story. We've had a few companies reporting this morning. Daimler is one of those that at least has given guidance, and so that could be one to watch. Siemens Gamesa, though, look out for moves on that stock in the other direction. So European equity markets just opening up, and we've got the FTSE 100 out of the gates and down by a tenth or so, 0.2%. The Stock 600 down by 0.1%. The IBEX over in Spain is down by 0.5%, so we'll keep an eye on what is happening over there on the periphery. We heard from Jay Powell, of course, yesterday. One day of testimony, another day of testimony is yet to come. Our colleague Mark Cudmore earlier on in the first hour of the programme talking about how Powell, there had been a slight risk perhaps that Powell could have been hawkish, and he's removed that tail risk. That really is the sort of assessment of what he was saying yesterday. So that's worth bearing in mind as we go into day two of Jerome Powell speaking. So European equity markets then firmly in the red. The French CAC 40 down by 0.3%. As I said, Fed Chair Jerome Powell says the central bank is a way off from tapering and that inflation is likely to be higher for some months. Powell spoke to lawmakers at the House Financial Services Committee yesterday.
Inflation has increased notably and will likely remain elevated in coming months before moderating. Inflation is being temporarily boosted by base effects as the sharp pandemic-related price increases from last spring drop out of the 12-month calculation.
Jerome Powell there giving us his thoughts on the US economy right now. Let's speak to Hugh Gimber, Global Market Strategist at JP Morgan Asset Management, who's with us this morning. Hugh, very nice to speak to you. Let's get your thoughts on what we heard from Jerome Powell then, because of course coming after that really strong or really high inflation print, much higher than many economists had anticipated, there were some who thought, well, maybe this will be a chance for the Fed to pivot slightly, but no, it wasn't. It was a reinforcement of many of the dovish messages we'd heard before. So did you take any nuance away from what we heard from Jerome Powell?
Yes, good morning, Anna. I mean, for me, this was a very consistent message to what we've heard really all the way through this year, that this is a Fed that are determined to be patient and are willing to look at what is a very sizable spike in inflation as a temporary one. I think when you look through Powell's remarks, he's talking really about the bar for the Fed to move being based on inflation moving materially and persistently above the Fed's targets. So with inflation where it stands today, you've got headline CPI north of 5%. I think everyone agrees that we've met the threshold on materially above target. The question really now is about persistence. And so where Powell is talking yesterday about not enough genuine inflation in the system, it comes back to the composition of what's driving the inflation basket. And really in the June print, I think there was something for everyone. You could look at the spike again in things like used cars and airfares and put those firmly in the transitory basket. But I think if you dig a little deeper, you can also now see some signs that there are persistent inflation pressures building in the system. So the shelter component being a good example, about a third of the basket, picking up to 2.6% year on year, starting to grind higher. I think that's the type of sign that the Fed will put more weight on, whilst they will continue to be very willing to ignore a short, sharp spike in things like used cars or airfares, which is much more likely to reverse.
So you can look, Hugh, at the output of inflation, I suppose, you know, the numbers that we get given and the breakdown, as you've just nicely taken us through. But you can also look at the drivers of inflation and what it is that is causing inflation to spike, either in core or in other parts of the economy. Is it still your assessment that this is very much supply side driven? And if so, does that trigger more patience, or does that suggest more patience? If it is no longer just supply side, then perhaps we make a different assumption about the amount of tolerance that central banks will have for this.
It's a tricky question to break down because for me, I think there are clear signs that the supply side is struggling to keep up. You look at things like supplier delivery times within the manufacturing PMIs, pointing to some real disruption. But at the same time, this is not just a supply issue. You look at how demand has really surged back. This is a mismatch on both sides of the supply-demand equation. And when we calculate, for example, the excess savings that US consumers have put away over the past 18 months, that gets me to a figure of around about 12% of GDP. You're seeing it in retail sales figures. You're seeing it in the mobility data. People's willingness to move around has picked up very notably in the US, back now to levels consistent with 2019. So this is about bottlenecks, yes, in the supply side that should ease over the next 12 months. But I think the demand picture is robust as well. And when you look ahead, wages starting to rise, for me, would be the key signal to suggest that the demand side is going to remain strong for some time, and therefore leading, I think, the Fed to start to change their tone on inflation later this year.
And anecdotally, we hear a lot about higher wages. What is the data actually telling us, though, Hugh?
Yeah, so I think you're seeing that. If you look at the June inflation print, for example, you have restaurant prices up very strongly, suggesting that some of those wage increases are starting to feed through into restaurant prices. Another way to look at this would be to take the survey data, for example. You take some of the surveys of businesses across the US, and they're pointing to record job openings. And we know, history tells us that when job openings are at record levels, typically the answer for that is for wages to follow, because businesses struggling to get their hands on the right workers are often left with little choice but to increase wages. So I think the labor market is setting up for a pretty strong recovery here. We think the data is again going to accelerate from August, and that the unemployment rate can start to fall quite rapidly, well, continue to fall, I should say, and with that, we should start to see some more wage pressure as well. So that, I think, is one of the key questions to watch over the next few months in trying to answer this question, not about the size of the spike in inflation, but rather the persistence.
Yes, so if this is about supply and demand being disrupted, Hugh, and you're watching for clues in the labour market, I understand. How much unwinding of a generous, a loose monetary policy environment are you expecting to see from the Fed? So, of course, you have to make an assessment about where they start or when they start. But then when do they stop? Because, of course, we came from a pre-pandemic world that had loose monetary policy relative to history. Do we remain in a post-pandemic world that has monetary policy that is relative to history fairly loose, or will things look very different on the other side? I guess this is a difficult question to answer at the moment.
It is, but I think the timetable for the Fed, at least for the next 12 to 18 months, is quite clear, in that we expect Jackson Hole most likely to be the start of the real tapering discussion. And then I think an announcement probably in December this year for tapering to start at the beginning of January next year is the most likely path. Now, as you say, after that, things do get a little more cloudy because I think the Fed are going to taper asset purchases only gradually, probably using most of next year to complete that. And then you start to look at rate rises in 2023. Now, ultimately, where they get to, I think, is still pretty unclear. But what I would say is that the Fed's determination to be late in tightening policy means that it's quite likely then that once they do start, they're going to have to move quite quickly. I think you can either be very gradual or you can be very slow to start, but it's hard to do both. It's hard to let the economy really overheat, wait and wait and wait before you start tightening, and then still go gradually. So I think that looking further out, there is a clear risk that the Fed not necessarily need to start tightening earlier, but once they do start tightening, they'll have to be tightening more quickly than the market currently expects.
That's a really interesting point there, Hugh. So if you start later, you have to move faster. Thanks very much, Hugh. Stay with us. Hugh Gimber, JP Morgan Asset Management Global Market Strategist, with us this morning on the European Market Open. Coming up here on this program then, stocks considered winners on the vaccine rollout are faltering as the Delta variant spreads rapidly. Is Europe's reopening trade in danger? We discuss that next. This is Bloomberg.
Silicon Valley.
This is the global center for high technology and innovation. What happens when big tech goes unchecked?
Too much power.
They're more powerful economically, socially, politically.
Is big tech going bad?
It's all about balance.
They're not bad because they're big.
I don't think big by itself is bad.
They're bad if they violate the law and if they hurt consumers.
Bloomberg Red Lines, U.S. and big tech. Friday on Bloomberg Television and Bloomberg Quick Take. infrastructure.
I think their entry-level wage rates are putting pressure on wage rates in certain markets. It is challenging, and we're competing for labor not only with other hospitality and travel companies, but with those industries that have thrived.
I think as we move to the fall in the United States in particular, the biggest constraint, other than, frankly, the virus pathway itself, is going to be the question of, can I get people to do the work, and can I get the goods to actually sell? And that's what we hear from our customers they're worried about.
The CEOs there of Marriott and Bank of America expressing their concern over shortages in the labour market, certainly a theme we have been talking about a lot, and wage pressures, and one we will return to. Welcome back to the European Market Open. We are just 12 minutes into our European trading session, and things looking a little negative for certainly the DAX and the CAC. The FTSE 100 a little flatter, the FTSE fairly flat this morning. Elsewhere, we see losses. As Europe looks towards relaxing restrictions, the Delta variant is causing the reopening trade to wobble. The continent is eyeing a summer reopening, but with infections surging across the world, stocks regarded as the biggest winners of vaccine rollouts have faltered in the past month. According to JP Morgan strategists, this could be an opportunity to build exposure as consumer fundamentals remain strong. Hugh Gimber from JP Morgan Asset Management, where he's a global market strategist, is still with us. So Hugh, you think it's still time to stick with cyclicals, time to stick with value. So if some of them get cheaper over the summer because of the spread of the Delta variant, and maybe Europe's reopening has to go a little slower, you think that's a good buying opportunity?
I think that's right, yes, because when you look at what's going on over the past couple of months, clearly we've seen a reversal of some of the excitement around the reopening that was in play in the first quarter of this year. And clearly, when you look at questions such as the Delta variant, anyone has to be humble in their ability to forecast how this is going to play out. But when you look at the data, it's quite clear that vaccines have so far been effective at containing the worst impacts of this virus. And so, yes, I think it's clearly not good news that we have the Delta variant spreading, and it creates more bumps in the recovery. But ultimately, I still think the path ahead is very strong. It's underpinned by significant policy support still in place and the very healthy consumer. So I would expect through the second half of this year that we will see a return to the reflation trade, higher yields, and that supporting Europe.
And so is the time for increased exposure to European assets, is that the second half of this year? I mean, arguably we've seen some of it already, but is it the second half of this year, or does the Delta variant push it into next year?
No, I think that expansion will still come this year. So when I look ahead, really what Europe needs to outperform is it needs the value style to be outperforming given the composition of that market. And so you can tie all of this back really to the path for yields as well. I do not believe that with 10-year government bond yields where they are today, that's consistent with the strength of the global economy. And so clearly there are some concerns for the market to work out around the Delta variant, but I would expect that as we move into September, October time, you're seeing that reflation trade back in play. You need the catalyst to come through. You need a US labor market acceleration.
Where does that leave the banking sector then, Hugh, in Europe in particular? Because I'm thinking here about how, if you're looking for global banking exposure, it seems that UK banks and US banks are going to be freer to return cash to shareholders, maybe European banks not so free to do so. Or are we going to see share buybacks coming back? Will that be something?
Past few weeks has been a little bit more cautious than that of the Bank of England, definitely more cautious than what we're seeing in the US. But I think the path of travel here is still positive for the banking sector, in that after a long hiatus of share buybacks and dividends, that's now getting back on track. And so I think if you're picking spots within financials, you probably are still looking more towards US financials than to European financials. But if you're thinking about global sectors, I think the banking sector is a good place to be at the moment. It's still undervalued. You're looking at more positive returns for capital to be returned to shareholders, and the outlook for rates, I think, is improving, albeit slowly. So I think there are catalysts in play for financials broadly to do pretty well this year, albeit I think the US probably still stands out as the best spot to do that at the moment.
Okay, thanks for your thoughts, Hugh. Good to speak to you. Hugh Gimber, JP Morgan Asset Management Global Market Strategist. Thanks for joining us on the European market open. And we will continue our conversation on Europe's recovery. At 9 a.m. London time, we'll be speaking to the Banca d'Italia governor and ECB Governing Council member Ignacio Visco. That conversation coming up at 9 a.m. Let's take a look at some of the stocks that are on the move this morning. I'll start with Avast. This is a cybersecurity software business, and the stock up by 14.7% this morning. Merger talks with Norton LifeLock, so that is part of what is driving, or that is what's driving that big move in the share price there. Siemens Energy also in focus. So these are energy assets spun off from Siemens, and the Q3 profit margin seems to be something that has the markets excited, and so as a result, or rather disappointed, not excited, and so as a result we see that stock moving down by just over 11%. Also TUI in focus, the UK government moving the Balearic Islands from the green list to the amber list, just 15 days or so since they put it on the green list. Of course, if double vaccinated, the rules are more relaxed, but it does mean if not vaccinated, then the rules around visiting amber countries are quite onerous, and so TUI moves lower by just shy of 3%. Let's get a Bloomberg Business Flash for an update on the top corporate stories we're covering this morning. Here's Laura.
Thanks, Anna. Netflix is taking its first major step beyond TV shows and films. The company is said to be planning to offer video games on its streaming platform within the next year. Former EA and Facebook executive Mike Verdu has been hired to lead the effort. A Bloomberg source says games will appear alongside current Netflix content, and for now, subscribers will not be charged extra. Shares rose in extended trading on the news. Daimler's preliminary second quarter earnings beat estimates as the pricing power of its Mercedes-Benz cars overcame lower production volumes due to a global chip shortage. Earnings before interest and tax surged to 5.1 billion euros, handily beating the Bloomberg estimate of 3.9 billion. BlackRock CEO Larry Fink says he sees the highest U.S. inflation in recent memory as more than a transient phenomenon. He backed up that view with a blanket raise for employees. The world's largest asset manager will increase the base salaries of all staff at the director level and below by 8% starting in September, according to a memo he and the firm's president, Rob Capito, issued Wednesday. That's the Bloomberg Business Flash. Anna.
Laura, thank you. Laura Wright here in London with your Business Flash. Coming up on this programme, Angela Merkel heads to Washington, D.C. with tensions over Nord Stream 2 firmly on the agenda. The details of that next. This is Bloomberg.
Up to Maine and had a lobster, and it's not as romantic as Lisa going to Greece.
Tom Keene says what?
You mentioned Maine and the lobsters up in Maine. Well, they can't compare to what you can see in Greece. Even better, I can't pronounce it. Astracoma carinata.
I nailed it.
It's not thera, whatever. Astracoma.
You're nailing it.
Carinata.
You're nailing it.
We're figuring out the hard stuff for you on Bloomberg Surveillance. Mornings on Bloomberg Television and Radio.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Welcome back to the European Market Open. 22 minutes into Thursday's trading session, and European equity markets actually deteriorating just over the last 10 minutes or so. The FTSE 100 was fairly flat, now down 0.2%. Other markets also making moves to the downside. A bit of M&A lifting things, though, for one London business. That is Avast, cybersecurity software business. Merger talk lifting that company up by 14%. Now, Germany's Angela Merkel is in Washington, D.C. to meet with President Biden in what may be her last trip as Chancellor. Some key transatlantic differences do still remain. Joining us now with analysis is Bloomberg's Berlin Bureau Chief, Birgit Jenen. Birgit, very nice to have you with us. So what are the chances then of an agreement between the US and Germany on Nord Stream 2? This has been a sticking point, a stumbling block between these two traditional allies for some time.
Yeah, I mean, and we do hear from Washington that talks are also still now difficult. So a breakthrough hasn't yet been achieved. But obviously, you know, the expectations are high that really when Merkel travels to Washington and Nord Stream has been right from the start on the top of the agenda, that they come up with something where they are at least something near a compromise, you know. Obviously, Nord Stream is a difficult issue because Germany basically says they are economically dependent on the gas supply via Russia, and that the pipeline is basically an economic project, and the US should not really mix into this. But obviously, this isn't really the only story. It is also a political issue. It is making the Ukraine dependent on Russia, and therefore the US is basically pushing for Germany to take a more political view and help the Ukraine to become more independent from Russia.
Yes, Angela Merkel in the past has wanted to sort of separate Nord Stream 2 from the politics. The extent to which the Americans can do that, or she could do that realistically, is interesting to watch. What are the other stumbling blocks, or what are the stumbling blocks then in these talks?
Well, Germany is willing to basically help the Ukraine to build up a hydrogen industry so that in the long run, the energy supply there is going to be sustained. But that is not the only thing what is needed in order to make the Ukraine more independent from Russia. I mean, the US is pushing for Germany to make a commitment and really an obligatory commitment that Germany is willing to stop flow from Russia if, like in the eastern countries, there is a new conflict arising. So Germany is somehow making some concessions, saying, okay, we cannot rule out that in the future Nord Stream will be stopped, but how firm that commitment will be, that is the big question.
And she also wants to remind the Americans that Europe wants to keep a seat at the top table when it comes to global geopolitical discussion.
Yes, exactly. I mean, this has been on the agenda for years. And there is also, obviously, the Europeans are not exactly on the same side here. I mean, France also plays a role. But I'm sure Germany will push this forward, but I do not expect an agreement at this meeting today in Washington.
Birgit, thank you very much. Not the first president that Angela Merkel has met whilst German Chancellor. Might be the last, though, of course. We were just showing some images of her over the years with other US presidents. Thanks very much for joining us, Birgit Jenen, Bloomberg's Berlin Bureau Chief. Coming up here on this program, steadying recovery. China's Q2 GDP comes in below estimates. We discussed the state of the world's second largest economy. The retail sales number, certainly that was one of the areas of focus. What do we take away from the recent monetary policy moves, the R cut in China? What was that designed to signal? And how do we see the Chinese currency performing from here? We'll get into all of that conversation along with some geopolitics as well. That's all coming up next when we talk about China. We'll also check these markets for you. This is Bloomberg.
2023 is entirely online, ostensibly because of the pandemic, but in large part, we're seeing a massive pivot to mostly live streams for video game coverage. We're going to be all online instead of in the convention center for the first time this year, and that promises to be a really different experience.
Industry has really been interesting during the pandemic. It has actually grown substantially since everyone was stuck inside. And of course, this makes sense, right? We're all looking for some amount of entertainment, and stuff like Fortnite in particular offer also a social component, right? People can join up and kind of meet up online and spend time with their friends. So in a lot of ways, this all makes sense.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Welcome back to the European Market Open. Half an hour into our European trading day for this Thursday. Just checking what these markets are up to now. And the FTSE 100 down by 0.2%. The DAX and the CAC see slightly bigger losses. So we are seeing a much weaker session coming through. And if we have a look at the sector breakdown, we don't have any sectors in positive territory. So this is quite broad, although it does focus very much on the energy sector. You'll see that this is one of the sectors that is really moving to the downside. So energy down by 2.8%, a real standout mover to the downside. And actually, there is just one sector now in positive, consumer products and services, just eking out a very small gain. But energy very much dominating the downside, as I say, down by 2.8%. And a couple of names just to mention, or three, in fact. There's clearly a renewable energy concern. Have we become overvalued in that particular sector? That's certainly something that many in that sector have been asking. So we see Siemens Gamesa renewable energy down by 15% or 14.6% over in Spain. That is weighing on the IBEX. That is something that the market is taking quite seriously. We see Vestas Wind Systems down by just 6%. Also with a similar theme in mind. Siemens Energy down by 9.7%. So there's a lot to think about when it comes to the renewable energy space this morning. Let's get a Bloomberg First Word News update. Here's Laura.
Thanks, Anna. Brazilian President Jair Bolsonaro will remain hospitalized in Sao Paulo after being diagnosed with a partial intestinal disruption. Doctors have ruled out emergency surgery for now. He had been moved to the hospital after suffering with abdominal pain after 10 days of hiccups. In the US, a handful of states with below-average vaccination rates are driving the most recent COVID uptick. Arkansas's case rate is the highest, while in Missouri, infections are at levels not seen since February, with below-average vaccination levels. The two small states accounted for 1/10 of new US infections in the last week. Cases across the US are low, a 7-day average of around 21,000 new cases, compared with more than 200,000 in January. Still, they're inching up as vaccines slow. And in Japan, the Olympics are still set for a July 23rd opening ceremony. This week, the central government reimposed a state of emergency in the pandemic of Tokyo, and a large block of the Japanese public wants the games called off. Despite this, Tokyo's governor, Yuriko Koike, told Bloomberg that she sees the virus-delayed games becoming a beacon of hope for the world, and says they are prepared.
We are preparing whatever the circumstances is, and the
hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna.
Thanks very much, Laura Wright here in London. Let's turn to China now. Economic growth slowed down in the second quarter in line with forecasts, showing that the recovery is steadying. GDP expanded by 7.9% from a year earlier, compared with a median forecast of 8%. It suggests Beijing can comfortably meet its growth target of more than 6% for the year. Iris Pang, ING Chief Economist for Greater China, joins us now. Iris, very nice to speak to you. So broadly in line then with this GDP number, with expectations. You have a slightly lower expectation, or you did have, for China this quarter. Why do you think that, or why did you have such a low expectation, and what does that mean for the second half of the year?
Before the release of this second quarter GDP, I actually forecast a 6%, so it is lower than the 7.9% report. So what I was thinking is that there were COVID for about 4 weeks in Guangdong, which is electronic production sites and also affects the ports there. And before that, the trade balance isn't so great. So I expect a little bit slower growth. And the factor behind that, which is coronavirus in the markets, export markets of China, like US and Europe, actually is still there. So the third quarter and fourth quarter could still be a little bit weaker growth.
Right. And what do you anticipate the PBOC will do here, Iris? And what signals did you take from the RRR cut, the reserve requirement cut for China's banks? Many would assume that that is a fairly looser monetary policy measure. What was your interpretation?
Yeah, let me answer your second question first. The RRR cuts together, before the release of this data, I can't really understand the RRR cuts, but now I understand it more. First thing is that the data isn't really that perfect. For example, the automobile sectors in terms of production, retail sales, and investments were all very weak. In some categories, they are in contractions. So this is one thing. It reflects the chip shortage, and it also reflects that some of the demand has been already reflected last year, as China was the first one out of COVID. And then we have Yellen saying that US is not going to talk with China at a high level. And then Japan also said that it has to be in line with the US in terms of confronting China in the area of technology. All this combining, then the RRR cut seems to be reasonable to be somehow preemptive for the risk that are piling up for the economy. And I expect your first question, and I expect another RRR cut in 3 months later. And maybe we have more if this situation do not change.
Iris, how much of a negative for the Chinese economy is the deteriorating geopolitical situation between the US and China? How much will that weigh on China's potential growth?
This is a difficult question. I don't know how to quantify it, but there are many fronts that the two are not actually helping each other. For example, on technology, it is very obvious that the two are now in a confrontation mode. And then on trade, after the trade agreement, the phase 1 trade deal, will we have phase 2? I really doubt that if there will be no talks, how can they have phase 2? Then remember that the phase 1 trade deal is to be expired by the end of this year. So it's very quick. It's just 4 months, 5 months away from now. And then we have more confrontations in terms of really political issues, for example, Iran.
Okay, yes, so the multifaceted tensions. I wonder what you think about the unemployment story in China at the moment, Iris. I was looking at the National Bureau of Statistics spokesperson flagging youth unemployment as being high, and unemployment pressures, according to that Bureau of Statistics, remain. What does that mean in a Chinese context?
It is not a 2021 issue. It has been an issue for more than 10 years, I think, that fresh graduates have difficulties to find the decent jobs. It's not like 10 years ago that if you are a fresh graduate from a university, you will definitely find a job, which is not really decent, but at least you will be either placed in university or in SOEs, when at that time private companies are not really big. But nowadays people want to take a career in private companies like the tech giants, not really interested in working in smaller SOEs or even government departments. So their mentalities have changed, but the supply is just that. So I think this problem will continue, and this is not a unique problem for China. I think this youth unemployment problem is everywhere.
Iris, thank you very much. Thanks for joining us. Iris Pang, ING Chief Economist for Greater China. Thanks for bringing us your analysis as we react to the data overnight. Coming up here on this program, Netflix and Game, the streaming giant, is making its first big move beyond TV shows and beyond films. We'll bring you all the details of that Bloomberg scoop next. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
We will, and we are in the process of a generational shift. So we've now done the entirety of generational shift at Apollo. And that means governance, that means one share, one vote, and that also means Leon stepping down from the firm at the beginning of the year and Josh stepping back upon the closing of the Athene deal.
That was Apollo CEO Mark Rowan there on the changes the firm has gone through in the past year. You can catch that full conversation with Bloomberg's Jason Kelly in our latest instalment of our Invest Talks series. That is at 4 p.m. London time. In a Bloomberg scoop, we can reveal that streaming giant Netflix is branching out into video games. It'll be entering a crowded marketplace competing with the likes of Nintendo and Sony. Netflix is tapping former EA and Facebook executive Mike Verdu to lead the effort in a move it hopes will differentiate it from streaming service peers. Joining us now is our Bloomberg Opinion tech columnist, Alex Webb. This is really interesting. So why this move now then, Alex? Why is Netflix doing this?
I mean, with so many tech companies, you can talk about whether you're selling iPhones or smart home devices, whatever. It's really just a fight for your attention. And at the moment, Netflix, yes, it competes with Disney Plus and with HBO Max and all those others, but it also competes with gaming, with Fortnite, with Twitch, with all these platforms for consuming or playing video games. And this is therefore, it's clearly its next act. Like, people have been asking, what is Netflix's next act? Is it going to be ads? Is it going to be something else? Well, there's something else. It seems to be video games, and it's a cracking scoop from Lucas Shaw and Mark Gurman to bring us the news.
Yeah, and is this something that other streamers are going to try and pick up on? Because I suppose if you're showing video content up to this point, film content, movie content, and other shows, the problem, I suppose, is keeping people watching once they've finished binging on a box set or they've finished watching the back-to-back films that are available. They might move off. Whereas if you're playing games, I mean, what's to stop them hanging around a little longer?
Yeah, exactly. It's reducing churn. Like, Netflix has a problem at the moment that its growth is sort of slightly stagnating, certainly in its home market. A lot of that is to do with, well, kind of everybody who wants Netflix has Netflix. But equally, churn is about how many people they're losing. People go, actually, I've seen everything that I want to see. I don't need to pay for my Netflix subscription anymore. So if they can add games, it makes it a little bit stickier. Now, don't forget, we can talk about competitors maybe following this play. Apple already does it. Apple is a competitor. It has Apple TV Plus. It also has Apple Arcade, which is a streaming, a subscription service of video games. So, admittedly, sort of mobile games, not exactly, Call of Duty, things like that. So there is already kind of a direct competitor on this basis.
Yeah, and so I wonder, is that who they're going up against? Other companies that do a multitude of things, so other companies that do streaming content, but they also do gaming, or are they actually going to go up against some of these gaming companies for which you need real hardware? Because it strikes me it's actually quite difficult to get hold of some of this hardware at the moment. If you wanted to jump on any of the hardware bandwagons, given chip shortages and distribution issues, it's quite difficult to get hold of some of these consoles.
Well, I mean, there are two things here. Firstly, we don't know what kind of games they're going to be making available. Is it going to be the sort of high-end things that you play on an Xbox, or is it going to be more mobile games, Candy Crush kind of idea? Secondly, this is something that is being enabled by higher speed data connections. We're seeing a lot of companies get into video game streaming. Google is doing it, Microsoft is doing it, Sony are doing it. That is something where you don't need to have in your living room a high-end console. All of that clever computing is done in the cloud in a data center half a mile, 20 miles from where you live. It is enabled by 5G and fiber optic connections. Now, the technology to do that isn't quite there yet, but it is coming, and it's going to be there very soon. So it means you don't necessarily need to have all the chips for everyone, because the data center console is only being used when you're playing it, and when you're not playing it, then someone else is. And so it's a way of actually using chips more efficiently, because you're not having an Xbox sitting in your living room not being used 19 hours a day, for argument's sake, and only then be used when it's needed.
That's still a lot of hours using it, Alex, just for the record. Bloomberg Opinion tech columnist Alex Webb joining us there with great insight into this fantastic story around Netflix. Thanks very much to Alex for joining us. Let's get a Bloomberg Business Flash. Some of the other corporate stories we're covering this morning. Here's Laura.
Blackstone is buying $7.3 billion of housing and insurance assets from insurer American International Group. The private equity giant also agreed to manage $50 billion from AIG's life and retirement portfolio. Blackstone and its peers have been attracted to insurance because it generates a steady stream of capital that can be invested. Daimler's preliminary second quarter earnings beat estimates as the pricing power of its Mercedes-Benz cars overcame lower production volumes due to a global chip shortage. Earnings before interest and tax surged to 5.1 billion euros, handily beating the Bloomberg estimate of 3.9 billion. BlackRock CEO Larry Fink says he sees the highest US inflation in recent memory as more than a transient phenomenon. He backed up that view with a blanket raise for employees. The world's largest asset manager will increase the base salaries of all staff at the director level and below by 8% starting in September, according to a memo he and the firm's president, Rob Capito, issued Wednesday. That's the Bloomberg Business Flash. Anna.
Laura, thank you. Laura Wright here in London. Now, the EU is announcing measures aimed at making Europe the first net zero continent by 2050. The laws would punish polluters while promoting sustainable development, but pushback from member states is already beginning. Bloomberg's Maria Tadeo caught up with the European Commission's Executive Vice President for the Green Deal, Frans Timmermans.
This is Europe. We still have a lot of convincing to do with member states of the European Parliament, but if we can get them to agree with us, then we can meet the goals.
And Mr. Timmermans, one of the points that you made is that this needs to be socially acceptable, and you kept highlighting that point. When you say socially acceptable, what do you mean, and how is it going to affect working class people that don't see the benefits of green policy?
Well, we don't have the luxury to leave anybody behind, both from a moral perspective, but also from a political perspective, because if people have the feeling they're going to be left behind, they'll stop the whole process. So we need to prove that this is socially just. So that's why we talk about just transition. That's why we've created also a social fund now. We need to make sure that those people who can't afford to make the transition are helped to make the transition.
And just very finally, the reaction from the industry, of course, you hear from the airlines, you hear from some of those sectors that will be hit by this, and they say it's too much, it's too quickly, I'm not sure if this is going to work. What's your message for them?
Well, you know, that's not the first time they say this whenever we come with measures. We believe this can be done. And they should understand that meeting our goals of at least 55% reduction in 8.5 years' time is a legal obligation.
And why was the language around the cars watered down? Some would tell you it has been. It's not as ambitious as it was initially predicted.
Nope. It's 2035, and it was always 2035 in my plan.
That was Frans Timmermans, the European Commission's Executive VP, speaking about Europe's plans for net zero, meeting Maria Tadeo and facing her questions. Coming up on this programme then, the Bank of England's Dave Ramsden joins the chorus warning on inflation risks. We'll dig back into the markets. That conversation next. This is Bloomberg.
curtain will rise again.
Broadway's returning June.
Have you bought tickets?
It's busted out.
You've got more time here.
Commodities are up.
Keep going.
To the moon.
Beautiful.
Bloomberg Surveillance, weekday mornings on Bloomberg Television and Radio.
This is a market that
over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to the European Market Open. 53 minutes into your European trading session, and we're bouncing a little back to the flat line in London. The FTSE 100 fairly flat right now. There you go, just unchanged. But elsewhere, we see some moves to the downside. The Xetra DAX down by 0.7%. Let's talk to Laura Cooper, Bloomberg Markets Live macro strategist. And Laura, it's interesting just how negative we have been this morning here on the European session, and some of that driven by some earnings stories. It's a little in the weeds, but I was taken by the Siemens Energy story, lowering its profitability guidance because raw material inflation is going to crimp its profits. And I'm estimating that's not going to be the only time we hear that message through this earnings report.
Well, that certainly does appear to be the case. And if we actually look at what happened last earnings season, we did see a number of companies report that inflation is going to be potentially problematic. So that could potentially hurt those defensive stocks that are going to potentially face margin pressures. But really, this just ties into the broader theme of what we're seeing come from central bankers. We had Bank of England's Dave Ramsden warn that the UK could face 4% inflation, and that could potentially prompt an earlier tightening of monetary policy. So I do think we are going to see just these broader inflation narratives continue to play out, both in earnings and on policymakers' radar.
Yes, and tell me a bit more about that commentary from Ramsden. Is that something that's really moving UK assets? Just looking at where the pound is trading this morning, it's actually down a little bit. We had some unemployment data out a little bit earlier on this morning, but it hasn't moved all that far, just looking at the last couple of days or so. Is this something that is moving expectations, this kind of commentary about just how high inflation is going to get?
It doesn't appear to be the case that markets are actually reading too much into those inflationary warnings. Yes, we did see wage pressures bounce higher in the employment data this morning, but when we look at what money markets are telling us, they're not really ramping up those expectations for rate hike bets. They're about pricing in about 10 basis points of hikes over the next year. That's very little changed from what we saw before that stellar inflation report yesterday. So I think the pound really is taking more of its guidance from dollar moves. So really markets are kind of watching these inflation risks, but not really too worried about it yet.
And watching the inflation risks stateside and sending the US 10-year yield lower, down below 1.32 once again.
Somewhat surprisingly, yes, just given the fact that we did see those dovish comments from Chair Powell, but really a familiar tune struck from him. And so I think what was surprising is the fact that inflation could potentially, yes, it's coming in stronger than expected. It could last longer. That could prompt them to be reactionary. But at this point, they're continuing to take that patient stance. Now is not the time to talk about tapering. So that is having yields below, sending yields even further lower. So it's really quite puzzling at this point, really, given the economic backdrop.
Laura, thank you very much. Laura Cooper, Bloomberg Markets Live macro strategist. Thanks very much for joining us. That is it for the European Market Open. Surveillance Early Edition is up next. European equity markets then have been lower, essentially, this morning. So we're seeing a lot of weakness across these European equity markets. The FTSE 100 fairly flat, but elsewhere we see moves to the downside. The Xetra DAX down by 0.7%. Surveillance is next. This is Bloomberg.
We're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there's been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada is going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Europe. We still have a lot of convincing to do, but if we can get them to agree with us, then we can meet the goals.
We have seen a banner year in 2020 for sustainability. There is a threat of greenwashing.
So if you're not sustainable today, but you want to be in business in 20 years' time, you've got to work on the sustainability agenda.
This is Bloomberg Surveillance, early edition with Francine Lacqua.
Well, good morning and welcome to Bloomberg Surveillance Early Edition on this Thursday, the 15th of July. I'm Francine Lacqua here in London, and these is what our top stories are on today's program. Staying vigilant, Jay Powell says the Fed is ready to take action if prices get too hot, but that it's too early to pare back stimulus. He faces more questions from the Senate today. In Europe, ECB board member Isabel Schnabel warns that inflation may return quicker than expected. We'll speak shortly with the Banca d'Italia governor, Ignazio Visco. And Player 2 enters the game. Well, Bloomberg learns that Netflix is planning a push beyond TV and film. The company hires a former EA executive to lead its efforts into video gaming. So let's get straight to the top market stories. And of course, the Fed Chair Jay Powell says it is still too soon to scale back the central bank's aggressive support for the U.S. economy. Facing the House Financial Services Committee as part of a two-day grilling, Powell stuck to his line. Inflation will be transitory. Now, he did also add that the debate amongst FOMC members would continue.
Inflation has increased notably and will likely remain elevated in coming months before moderating. Inflation is being temporarily boosted by base effects as the sharp pandemic-related price increases from last spring drop out of the 12-month calculation. While reaching the standard of substantial further progress is still a ways off, participants expect that progress will continue, and we will continue these discussions in coming meetings. As we've said, we'll provide advance notice before announcing any decision to make changes to our purchases. It really is a very broad range of things, including wages, unemployment, levels of employment, participation, all those things. So we just said substantial further progress. And we also said that we would provide advance notice, well in advance of actually tapering.
Well, let's talk about the markets now with Bloomberg's Eddie van der Walt. Eddie, when you look at inflation, what we heard from Jay Powell, what we also heard from BlackRock's Larry Fink, what exactly the market seems to be taking on their stride, and just looking at dollar levels?
Absolutely. You know what? This has really been interesting, particularly those BlackRock comments. I think you've absolutely nailed it on the head. Because in BlackRock saying they are seeing wage pressure, and they are pushing wages up by 8%, right, across the board for their employees. But the Powell had an answer to that. Powell said, listen, the supply pressure in the labor market is going to start to soften in the coming months. And I think that is the big question for markets at the moment, because it's one thing to see manufacturing inflation coming through and inflation of oil prices and all of these other things. It's quite a different thing to talk about the pressure that's coming from the labor market. And if that is going to be the real key to whether this is transitory or persistent.
Eddie, we also had some data out of China. How important is that, given all the concerns we had on China and the fact that PBOC maybe had to support the economy? It feels like now they're steady, and actually there won't be an extra need for support from PBOC.
Yeah, I mean, it's hard to imagine that the PBOC didn't have an inkling of what these numbers are going to be before we saw them. So I think China is looking at these numbers, and they're really hard to unpick because there's the base effect, and there's a lot of things going on. But I think China is the other half of the discussion. There's been a lot of pressure coming on supply chains on the manufacturing side of economies. And particularly that was because during the coronavirus, people were at home, they didn't spend money on services, they didn't spend money on restaurants, they spent all their money on goods. And a lot of those goods come from China. That caused supply chain disruption and pushed up prices for manufacturers. Now we're seeing that starting to ease because people are starting to spend on services again. And I think that's what we're seeing here. China, there's a pivot away from growth that is very reliant on China. So I'm not too worried. I think that could actually take some of the inflationary pressure off, while at the same time not hurt growth in the West too much.
I'm looking at WTI, Eddie, and it's at just below $72 a barrel. What are we expecting from OPEC Plus? It seems that the UAE may actually fall into line with some kind of agreement with the Saudis.
The OPEC alliance stands strong, and I think that's really interesting. But what this is telling us, because if the UAE, if they are allowed, to pump a little bit more, because their baseline's being moved higher, then others come early next year, are going to push to pump more oil. Other members of the alliance are going to push to pump more oil. So I think what this is telling us is that in the short term, the OPEC alliance held strong. So that kind of puts a cap on the amount of oil, and the oil market will be able to absorb the amount that's flowing in the short term. But come next year, it's going to be harder and harder to tell all the other members, listen, you've got to pump as much as you did last year. So therefore, we're likely to see an increase in supply next year, which again takes some of the pressure off the price rises and off inflation. And potentially, I think that could just help Powell in making the case that this is transitory going into next year.
Eddie, thank you so much. Eddie van der Walt there from our MLive team. Now, coming up, we'll have plenty more, of course, on the economy in the U.S., but also China. This is who we'll be talking to. We'll talk inflation with the governor of Italy, Mr. Ignazio Visco, and then we'll also be speaking with the St. Louis Fed President, James Bullard, and the Chicago Fed President is coming up as well. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, there's quite a lot going on in the markets, and of course, the big one is inflation. The ECB giving the green light to a multi-year project to create a digital version of the euro, an electronic equivalent of banknotes and coins. The digital euro will likely be similar to an account that euro area citizens can keep at the central bank rather than the commercial bank. Well, the initiative comes as the European Central Bank also seeks a way to meet a growing demand for digital payments, as well as tackling a boom in cryptocurrencies. Well, joining us now from Banca d'Italia is the governor, an ECB governing council member. He's Ignazio Visco, of course, fresh out of a very successful G20 that was held in Venice, Italy. Governor, thank you so much, as always, for joining us. I want to talk about growth. I want to talk about inflation and the G20. Did you come out, first of all, congratulations on the G20. Venezia was beautiful, as always. Did you come out of Venice G20 actually feeling a bit more optimistic or a bit more worried about the path forward for the global economy?
Well, yes, it was, first of all, it was a good meeting. I think a lot of results, notwithstanding some criticism which I read recently. But I think the assessment on the recovery was a confirmation of what we expected in April. There is a recovery which is getting pace, but it is not homogeneous across the world. There are a number of countries who are still lagging behind. It is very much dependent on the speed at which the vaccination campaign is taking place. It is also less than complete as a recovery. So we think that it will take still about a year before we really are out if a number of conditions take place. One is the obvious, that is the ability of countering a third wave, if you want, of the infections. Then really the pace of demand at the world level has to be maintained as it is. Monetary conditions, financial conditions have to remain favorable, even if we have signs of some price increases that are above the targets that all central banks have set.
So, Governor, we also caught up with the ECB president earlier this week, and we had a conversation about your very important meeting on July 22nd. What exactly do you think will come out of it? Can we see a policy shift after the strategic review?
Well, May 22nd is one of the meetings on monetary policy that we have every 6 weeks. Obviously, it comes after the decisions that we took on the revision of our monetary policy strategy. So it will be seen in that frame. What we are observing now is a situation basically in line with our expectations. There is an agreement that we really have to maintain very favorable financing conditions for a long period. There are two risks that we have to avoid. The first is, or to counter, the first is not making mistakes ourselves. So clearly we have to avoid, say, tapering before the time comes that we are really confident that we are back where we should. And the second is really if there are some exogenous shocks, market developments that would push, say, interest rates on the upside in a situation in which there is still a substantial slack in the economy in the euro area, then we really have to show that we are determined. And we have just said that in our revision of the strategy, that when we are close to the lower bound, which is a level below which interest rates really cannot go without having very negative consequences, then we must have a much more forceful and protracted or monetary policy stance that convince basically the markets of our determination, and that may even imply a moderate and temporary period of higher inflation above the target that we have.
Yeah. So, Governor, given what you've just said, if we look to the autumn, is it likely that we'll need an extension of PEP?
Well, we have not discussed that. And I understand that there are a number of declarations made outside the Governing Council, but this is something that we have to discuss in the Governing Council. As I said before, we need to maintain financing conditions absolutely favorable for the recovery. At the same time, I only want to remind that the PEP was a set of emergency measures that were introduced in March last year, basically to counter the higher volatility, much higher volatility and shocks in a fragmented market condition. And at the same time, however, was also part of the whole strategy of, for us, going back to the aim of 2% in the rate of inflation. We are still behind that below the 2%, even if in the recent months, because of temporary effects, we are close to 2% on average, but our projections are still much below that for the next couple of years. So the stance has to remain. Then we have to discuss
Governor,
how to have it.
Right, and actually, we also have to discuss how you then transition from emergency stimulus to a more normal stimulus. How quickly could that happen?
Well, the transition is a complicated thing that we have to discuss among ourselves, but I think that we have really to show to be determined. I think that at the end, it is extremely important the fact that the Governing Council had reached an unanimous approval of the new strategy. And the new strategy sets really the pace. So I don't see a very complicated problem on the monetary side. I see substantial risks on the real side. We still have a substantial economic slack in labor markets. Still have not back where they were before the pandemic started, but I think the determination and at the end also the consensus in the council is pretty important.
But Governor, do you expect policy to actually be normalized or tightened at a further date because of the new mandate that you were just laying out?
I mean, I don't understand what you say.
So in terms of normalizing, do you think that will take place? Yeah, so my question was, do you expect monetary policy to be tightened at a later date? So, you know, more go basically,
as I said,
keep it looser.
No, as I said, I don't expect monetary policy to be tightened for a long period. The issue here is how to avoid really that the market somehow, because of transmission of shocks from other parts of the world, the US clearly is now having a recovery which is much faster than Europe, and the inflation rate is much higher. I mean, we have really to avoid that this takes place in the euro area. And this is what we look with care even in our decisions on the asset purchases and related measures. This is I think rather necessary, and I think we are determined to do that. The exact way, whether through PEP, whether through APP, whether through interventions in the banking sector and so on, is all a set of tools that we have to discuss and agree upon. And this will start the 22nd of this month, but it will continue in September.
Governor, what does moderate overshoot for a transitory period mean to you? Is it a couple of months transitory? Is it a couple of quarters?
Well, this is a question which we have to assess case by case. It has to be put in the perspective of the projections that we will generate over a period of months and quarters and years. As you know, the 2% is a medium-term aim. And therefore we have to extract the signal from the actual data that we will observe. It will be a matter of judgment and a matter of clearly statistical intervention. It may be moderate for some time, which means quarters, which means the projection period that we have. But what has to be very clear is that we are not following a model in which we are going to recover from the losses or from the actual observations of inflation in previous months and making up in the future. We are starting from an initial condition and we will look forward. So once we will be there, we will consider how the projections will look, and then we will judge whether they look moderate and transitory.
Governor, very quickly, I know you worry about variance. What kind of, if we see uglier variance coming, what does that mean for the European recovery? And what does it mean for Italian growth?
Well, I'm worried, obviously, from many issues that worry us. One thing is clearly the pandemic and the way we will have to face another wave if that scenario takes place because of the also behavior that our citizens have. So that may affect confidence. We are in a period in which there is substantial, I'd say, confidence on the part of enterprises. Investment plans are there. They are most likely also taking into account the changes that have been induced by digitalization during these very complicated years. But it will not only be that. There are also the fears of consumers. We have pent-up demand that has to be put back in place, and for the time being, while the saving rates might be slightly going down, are still much higher than they were before the pandemic started. Then there is foreign demand. Since, as I said at the beginning, there is heterogeneity in the way the response to the pandemic is taking place, then for the time being we have a positive view about future developments, but if there are, say, slowdowns in the way the vaccination campaign takes place, then that may affect our economy too.
Governor, thank you so much. As always, the Banca d'Italia Governor and ECB Governing Council member Ignazio Visco. We'll have plenty more on the markets next. This is Bloomberg.
Countries that entered this crisis with limited fiscal space, with more vulnerabilities, need to be supported for the benefit of the world.
The transparency of the debt burden for the poorest countries needs to be increased. There needs to be fuller disclosure.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Trading revenues coming in better than expected. Everything. Cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Staying vigilant, Jay Powell says the Fed is ready to take action if prices get too hot, but that it's too early to pare back stimulus. He faces more questions from the Senate today. In Europe, ECB board member Ignacio Visco tells us that the central bank must avoid premature tapering. His colleague, Isabel Schnabel, warns that inflation may return quicker than expected. And Player 2 enters the game. Well, Bloomberg learns that Netflix is planning a push beyond TV and film. The company hires a former EA executive to lead its efforts into video gaming. Well, good morning, everyone. I'm Francine Lacqua in London. Welcome to Bloomberg Surveillance, the early edition on this Thursday, July 15th. Now, there is quite a lot going on in the markets. Time also for our big take, and money managers in the States couldn't stop the march towards exchange-traded funds. So instead, they actually decided to join in. Well, what was once a march has now turned into a stampede. The ETF industry in the U.S. is actually preparing to shatter an annual record with several months still left of the year. At $483 billion and counting, they'll likely break the near $500 billion record set in 2020 in weeks, possibly days. Within that surge, there seems to be a capitulation by the mutual fund industry of historic proportions. Now, you can read today's Big Take on typing NI Big Take Go on the Bloomberg terminal. Joining us now to talk about inflation, to talk about his investment strategy is Benjamin Mellman. He's a Global Chief Investment Officer at Edmond de Rothschild Asset Management. Benjamin, thank you so much for joining us on Surveillance on such an important day, post-Powell, post-BOE, and of course we have that wonderful story on ETFs. Do you play into ETFs at all? Is it something that you think will grow in the markets, or do you prefer to play indices and stock pick?
Well, actually, ETF, of course, is a very important part of the management. But as you know, dealing with markets, we try to achieve a long-term performance. We want to beat the markets. And of course, that's what ETFs are not doing. So ETF is part of the management, but it's a tool, not a final goal, in my view.
What kind of, Benjamin, regime shift, if any, are you expecting from the Fed and central banks? And is this what's underpinning some of the market worries that we see and some of the things that you absolutely need to get right?
Yeah, absolutely. Actually, in our view, we are living the best of the world, which was flooding liquidities and accelerating growth. And we are slowly going to a new universe where growth is peaking. And as we know, we are expecting the moment, the day, so it might not be today if we heard well what Mr. Powell said yesterday, but the day the Fed will announce the tapering for next year. So we will have less liquidity, a slowing world growth. It will be a different universe, less bullish for risky assets, probably more volatility. It's not a bearish environment. It's a new environment. We are living the best of the world.
So, Benjamin, I know you like European equities and Japanese equities. Is that on valuation?
Yeah, well, usually when we see a strong growth, even if world growth should decelerate somewhat, we know that US equities are not the outperformers usually, even if growth comes from the US, as it is the case again. So we think that we need to remain on cyclical plays with more attractive valuations. We need to have also more balanced portfolio construction on equities with value, growth, equity, and quality, sorry. And therefore, we think that being overweight Europe and Japan is a good way to keep a leverage on the world recovery and being more balanced in terms of size.
Benjamin, overall, when are you expecting correction? And in the lead up to a possible correction, are you expecting quite a lot of volatility over the summer into autumn?
Well, it's very difficult, to be honest, to call a correction. We think that the environment will be more prone to volatility when the Fed announces tapering, when the market will pay more attention to liquidity and the timing of the first rate hikes and the number of rate hikes. So far, we have seen the case with the very strong CPI data. It's not the case. We are still in benign neglect mode. But when the Fed announces tapering, the environment will become more fragile, and therefore any bad inflation surprise, any bad news could have more impact on the market, which so far has not been the case. So we might see more volatility. We do not expect a correction by the year end. Maybe next year will be more challenging.
Benjamin, can you talk to me a little bit about bonds as well? Is there anything in bonds that you would be buying right now?
Well, to be honest, bonds are quite expensive right now. As we discussed, yields are very low. US 10 years rates are so low. French yields are at zero. So it's very difficult to have some decent returns, and spreads are tight. Anyway, so we in our asset allocation are underweight fixed income. But we see some values in European financial debt, which is still having some spreads and very strong fundamentals, but also on high yields, some below average maturities.
Benjamin, what's your outlier call? Is there anything out there, I don't know whether it's something in a currency pair or whether it's a part of the industry that you think is unloved, whether it's travel and leisure, that you think is a little bit of a bold call, that you're going, you're not cautious about it, that you think is actually a good deal, which not many other people saw?
Well, to be honest, we are part of that deal. We are invested in it.
All right. Benjamin, thank you so much. Thank you for your time today. Benjamin Melman,
thank you very much,
Global Chief Investment Officer at Edmond the Rothschild Asset Management. Now, onto some politics. And Germany's Angela Merkel is in Washington, D.C. to meet with President Biden in what may actually be her last trip as chancellor to the U.S. Over the course of her 15 years leadership of Germany, she has crossed paths with 4 different U.S. presidents. And while she may find President Biden an easier ally than previous U.S. leaders, key differences between the two nations still exist. Likely to be on the discussion table, the U.S. opposition to Nord Stream 2 and trade tariffs put in under the previous administration. So let's discuss all of this with Bloomberg's Berlin Bureau Chief, Birgit Jennen. Birgit, great to have you on the program today. So what are the chances, first of all, on an agreement between the U.S. and Germany on Nord Stream 2?
Well, we do hear from Washington that until the last minute, no breakthrough has yet been achieved. Discussions have been difficult sort of for weeks and months. Germany, while is willing to give some concessions in terms of setting up a hydrogen industry in the Ukraine, but it is not yet willing to make concessions in terms of actually paying paying and giving straight aid to the Ukraine to compensate for the loss of the gas flow. And also another big issue, a stumbling block, is kind of a guarantee that Germany would stop Russian gas transition if there is a new conflict in Eastern Europe. So the question is really, how far will Merkel go? It is willing to make concessions to the Biden administration to get the relationship with the US on a new grounding.
So, Birgit, how much of the other conversation will, of course, be on travel? So it seems that European Union leaders are now really fed up with the fact that the U.S. still won't allow Europeans to go to their country.
You mean in terms of the corona crisis? Well, I do think this is going to come up, but I mean, let's be honest. Also, the Europeans are again tightening the border controls. It's we see in the high season of tourism that also the Balears, Spain is being closed down or tightened again. So I don't think this is going to be a major issue of contention between Germany and the U.S.
All right, Birgit, thanks so much. Birgit Jennen there, Bloomberg's Berlin Bureau Chief, the very latest on Angela Merkel's visit to the White House. Coming up, we talk about Netflix with a big gamble away from films and TV, also going into gaming. This is Bloomberg.
Silicon Valley.
This is the global center for high technology and innovation. What happens when big tech goes unchecked?
Too much power.
They are more powerful economically, socially, politically.
Is big tech going bad?
It's all about balance.
They're not bad because they're big.
I don't think big by itself is bad.
They're bad if they violate the law and if they hurt consumers.
Bloomberg Red Lines, U.S. and Big Tech. Friday on Bloomberg Television and Bloomberg Quick Take.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Economics, finance, politics. This is Bloomberg Surveillance, early edition of Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Brazilian President Jair Bolsonaro will remain hospitalized in Sao Paulo after being diagnosed with a partial intestinal obstruction. Doctors have ruled out emergency surgery. That's for now. He had been moved to the hospital after suffering with abdominal pain after 10 days of hiccups. And in Japan, the Olympics are still set for a July the 23rd opening ceremony. This week, the central government reimposed a state of emergency over the pandemic in Tokyo, and a large block of the Japanese public wants the games called off. Despite this, Tokyo's governor, Yoriko Koike, told Bloomberg that she sees the virus-delayed games becoming a beacon of hope for the world, and she says they are prepared. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now, in a Bloomberg scoop, we can reveal that streaming giant Netflix is actually branching out and producing video games. It'll be entering a crowded marketplace, competing with the likes of Nintendo and Sony. Well, Netflix is tapping former EA and Facebook executive Mike Verdu to lead the effort in a move it hopes will differentiate it from its stream servicing peers. Well, joining us now is our Bloomberg opinion tech columnist. He's Alex Webb. Alex, great to have you on the program. So why is Netflix doing this? What's the motivation behind it?
Well, we're increasingly seeing that, tech companies, you might think they're in, film or TV shows, and others are in social networking. Actually, they're all just in a competition for our time. And we've seen that growth at Netflix, particularly in its home market, is stagnating a little bit. It's therefore trying to get more into the space of companies like Fortnite and Amazon with Twitch and compete on those fronts. It's there's long been questions about what the next act was going to be, whether it's going to be advertising perhaps. This, I think, looks like it's the answer, and that's their play to continue the growth story.
So what impact are we likely to see from this on other streamers? Do we expect similar moves from them?
Well, the irony is actually Netflix, in a sense, responding to what others are doing. Apple has TV Plus, but it also has Apple Arcade, which is a subscription video game service, admittedly, just for mobile games. We're seeing Google has Google Stadia. It also has YouTube. Amazon has Twitch, which is a way of watching video games, at least. It also has Amazon Prime. So, in a sense, it is innovative, perhaps in the way they're going to present it, because it seems like it's just going to be another option alongside the shows they already have. But in another sense, it is a response to the existing competition they have.
Alex, overall, does it actually put some of these streamlining companies in a bad place, or is there something a little deeper into why they want to go this? Are they desperate for more revenue to have a more balanced portfolio, as it were?
I mean, it is just the hunt for growth. At this stage, I think it increasingly looks like everybody who wants Netflix in, developed economies developed to Netflix, like the US, they already have it. And then you start to worry, well, are you going to keep those subscribers, or are they going to churn out and decide, actually, they've seen every show they want to see on Netflix, they're actually going to go to HBO Max or Disney Plus or somewhere else. So if you have video games, perhaps people play them for longer. You don't necessarily need just to have an hour's worth of content, and when you've watched that, you move on. You can play the same game for hours and hours and hours and hours. So it perhaps builds stickiness with your existing customers and discourages them from quitting for rival services.
Alex, thank you so much. Our quick take reporter, Alex Webb. Now, coming up, the EU announces quite a lot on climate change. It's net zero plans, but member states are already arguing over who will foot the bill. So can Europe actually afford to be the first carbon neutral continent? We'll have the details next. This is Bloomberg.
Up to Maine and had a lobster. And it's not as romantic as Lisa going to Greece.
Tom Keene says what?
You mentioned Maine and the lobsters up in Maine. Well, they can't compare to what you can see in Greece. Even better, I can't pronounce it. Astracoma carinata.
I nailed it.
It's not thera, whatever. Astracoma.
You're nailing it.
Carinata.
You're nailing it.
We're figuring out the hard stuff for you on Bloomberg Surveillance. Mornings on Bloomberg Television and Radio.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
What we did today is in tandem with what I'm doing with financial services. So this Fit for 55 package is about updating legislation because we have higher ambition for 2030, 9 years away, so very soon. And what we're doing on the financial side is making sure that the financial system goes or looks green, but also finances green. So we've had a number of measures, including disclosures, a European taxonomy of what is sustainable economic activities. And last week we had this transition strategy because we want to be more inclusive, global. And also a key point for me is that the financial system itself is subject to real instability because of climate change. So we're looking at how do we factor all of these risks into the financial system. Now, today's discussion, I've just come from a really busy college meeting, was on this package, as you've referenced. And look, what we all need to understand, wherever you are, that if you believe that climate change is real and you know that time is short, you can't say, yes, I want to change, but just not now. Don't ask me, ask a friend. All of us have to change. So it's not an easy message, but my message to the financial system since I took over this role here is quite a severe one, because the financial system has the capacity to give us the resources to do all of this change. Firstly, by investing in what is green today, but also investing in the transition, and maybe looking at some of those investments that are not sustainable and perhaps turning away from them, because we need, if you like, those three pathways. And for me then, it's how do I identify for the financial system what is economically sustainable? What am I asking of corporates, large and small, to do? And what I say in a simple way is look at our taxonomy, which does identify what is sustainable, as a management tool. So if you're not sustainable today, but you want to be in business in 20 years' time, you've got to work on the sustainability agenda, whether you're large or small. So in a way, there's a lot of pieces of our, if you like, jigsaw coming together on the financial side and on the legislative side. But it's a lot to take in. And I really, when we're talking to citizens and business, it's to try and reassure people that we're not doing this without being sensitive to the consequences, socially, politically, etc. But in one sense, to state very clearly, we don't have a choice. We have made legal commitments to reduce emissions and to be climate neutral by 2050. I hope to be around for 2030 to achieve those targets. I'm not sure about 2050, but I will have family who will be around, and I want to make sure that the world is fit for purpose by that time.
Well, that was Mairead McGuinness, Commissioner for Financial Services, Financial Stability, and of course the Capital Markets at the European Commission. She spoke to me yesterday at the Bloomberg Sustainability Business Summit on green financing. Now, as the EU announced its path to net zero, the political fallout is already beginning. Poland, for example, wants its EU partners to pay the bill for weaning the country off coal, whilst France is resisting the drive towards electric vehicles. Well, the plan would see the continent cut emissions by 55% in the next decade, with total carbon neutrality by 2050. Joining us now live from Brussels is our European correspondent, Maria Tadeo. Maria, first of all, good morning. Second, it does seem like hitting these targets will definitely be a challenge, but we've also heard from the EU that there's actually no turning back. So how will they achieve those ambitions?
Yes, Francine, and you know, in your interview that we just played, that message was very clear. The time is very short. We're looking at a reduction of 55% by 2030. That is 9 years from now. Yesterday, the head of the European Commission also repeated that line. The fossil fuel economy has reached its limits and we need to move forward. Now, Francine, again, this is touching basically every pillar in the European economy, from the pricing of carbon to the emissions, but also energy efficiency. And of course, it's not going to impact every country the same way. For Eastern European countries, this is a huge leap forward. And of course, we also had that reaction yesterday from a number of industries, the airline sector, the maritime sector, the shipping sector, saying this is perhaps too quick. But it's also interesting that when I spoke to Frans Timmermans, the man behind this, I asked him how much leeway for negotiations is there, and this is what he had to say. Let's take a look.
We believe this can be done. And they should understand that meeting our goals of at least 55% reduction in 8.5 years' time is a legal obligation.
And that was Frans Timmermans speaking to us right after he announced the Green Deal package. It is, however, worth noting, Francine, that the one area in which he did say Europe has to listen and cannot repeat the mistakes of the past is the social impact that this can have. You know, we've seen it that perhaps going too green at times for the working class communities across Europe is something that they are affected by in their bills and the amount of money that they have to pay, but they don't fully see the benefits reflected in their everyday lives. That was something that Frans Timmermans told us we cannot repeat those mistakes of the past.
So, Maria, also on pricing, Europe is proposing a border carbon tax. How will it actually work?
Yeah, so this is something that we were expecting, and we now know it will be official, and it will affect steel, cement, fertilizers, and aluminum. And, you know, this is something that Europe says should not be considered a tax, but essentially it will be a levy on imports from heavily polluting industries into the European Union. The concern is that it could trigger a green trade war to some extent, but the EU does say that it will be WTO compliant, and that if anything, Francine, the rest of the world should follow past, that they should compete on the upper bound on cutting emissions and being greener, not wanting to pollute more somewhere else. So again, whether that triggers or not, tensions remains to be seen, but the EU says that it will be 100% WTO compliant.
Maria, thanks so much. Maria Tadeu there, our European correspondent live from Brussels. And Maria and I actually will be on Twitter. I know you work so hard, Maria. I'm actually having an espresso to your health. Let's look at the markets. Stocks and futures are actually a little bit mixed after we had some data out of China that was pretty encouraging, but we also had some various inflation reports, not only from Jay Powell yesterday, but also from various governors, for example, in Europe. So I'm looking at U.S. stock index futures, mixed. European equities actually falling. Investors, again, assessing a growth slowdown in China, but it wasn't as bad as some people are expecting. And also some dovish comments from the Federal Reserve Chair, Jay Powell. China's second quarter growth actually slowed largely in line with expectations. And then the other thing I'm watching is quite a lot of earnings. Our big take is also on something that's quite interesting, which is ETFs. The fact that in the first 7 months of 2021, there were more people going into ETFs than in the previous years. And WTI futures, they're tumbling below $73 a barrel on expanding U.S. fuel inventories. And, of course, the other big story is a potential OPEC Plus agreement to increase supply. Bloomberg Surveillance Early Edition continues in the next hour. Danny Berger joins me out of our London headquarters. Kaylee Lyons will be in New York. This is Bloomberg.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
this is Europe. We still have a lot of convincing to do, but if we can get them to agree with us, then we can meet the goals.
We have seen a banner year in 2020 for sustainability. There is a threat of greenwashing.
So if you're not sustainable today, but you want to be in business in 20 years' time, you've got to work on the sustainability agenda.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua, Matt Miller, and Keely Lines.
It's 10 a.m. in London, 11 a.m. in Berlin, 5 a.m. in New York, and 5 p.m. in Hong Kong. On this Thursday, July 15th, our top stories today. Powell on Capitol Hill, day 2. The Fed chair gets ready for more questions on tapering and how long the economy will be stuck with higher inflation. Consumers do their part in China. Retail spending picks up as the country's economic rebound shows more balance. And Merkel's agenda in Washington, the German chancellor is likely to press President Biden about opening up the U.S. to travelers from Europe. I'm Danny Berger with Francine Lacqua in London and Kaylee Lines over in New York. Matt Miller is off all this week. And guys, epic change. That is the 2 words from Larry Fink over at BlackRock to describe U.S. inflation. Certainly not the tone you were trying to strike if you're Chairman Jay Powell yesterday in front of Congress. But Francine, is all of this just good news only for BlackRock employees? It means you get an 8% pay rise when you're waking up today. I mean, hey, that's wage pressure right there, isn't it?
Yeah, that's not bad at all. And actually, that goes back to the war of talent and competition and actually what some of these asset managers will do to attract the right talent. But on inflation, look, if we start BlackRock, doing the same, or JP Morgan doing the same as BlackRock, maybe Bloomberg will do the same. Maybe other companies will do the same, but that's when inflation is a problem. I have to say, I really enjoyed Jay Powell yesterday talking about inflation because he really tried to assure a very anxious Congress. And that's what surprised me. Congress was really anxious about this inflation expectations. And he said, look, if it's persistent above 2% for too long, we'll do something about it. And that's probably playing out in the markets, Kaylee.
Yeah, it is. It was interesting testimony on Capitol Hill yesterday, Francine, given how political it was. Congress really pushing him on whether it's the fiscal policies of the Biden administration leading to this inflation and the labor shortage we are seeing in the labor market. As for what the picture looked like in Asia overnight, it was a bit of a mixed bag. You had the big underperformance coming from Japan, the Nikkei down more than 1 percentage point as COVID cases are getting worse in Tokyo. Outperformance, though, from Hong Kong and from China, the CSI 300 up about 1.4% or so after that GDP data. Yes, the growth is moderating, but at 7.9%, it was roughly in line with expectations. And the fact that retail sales beat is a good sign that the recovery is actually balancing out. Now, after that data, the Chinese yuan not really going anywhere. We're sitting at 645 at the moment. And one of your big outperformers in the G10 space is the Japanese yen. We are back below 110, stronger against the dollar by about 0.2%. As for what the picture looks like here in the U.S., you did have Powell sticking on message yesterday, the transitory inflation, the idea that significant forward progress has not yet been made. As for what the picture looks like ahead of day 2 of his testimony, we're not really going anywhere in the futures market. S&P 500 futures only up about 0.5 point at this point. We are seeing, though, some bigger movement in the bond market. The 10-year yield down almost 4 basis points. 1.3% is where we sit. Some action to note in the commodity complex as well. When it comes to oil, futures down about 1% after a decline of nearly 3% yesterday. On the one hand, U.S. supply picking up to the most since May of 2020, and the UAE looking to reach a deal on output with OPEC. So all that adds up to more supply that is weighing on oil today. Gold, though, ticking higher for a third day. Futures up about 0.5%. Actually, gold futures now at the highest in about a month, Danny. And of course, that is as the market weighs this inflation question.
Finally, redemption for gold. I mean, it's been just underperforming chronically. The gold bugs really want to see those gains there, so probably good news. Well, when it comes to Europe, it's a negative day. We saw this big bid for big tech in the U.S., and that's bad news for these European markets just because they are so cyclically focused. So markets like the DAX, for example, in Germany, which is down 0.5% today, because this is a high beta sector, it's not performing well. Now, really, one of the few places that is doing better today are UK stocks, FTSE 100 up 0.1%, really, though, down to FX FX effects to currency effects. You can see the pound on the bottom of my board here, cable at 138.43. That weaker pound giving up some of yesterday's gains over those inflationary concerns in the UK, and that is lifting UK stocks. But really, throughout the entirety of the rest of Europe, what's really weighing on us here is this concern over the energy space. You can see the Europe Stock 600 energy sector down 2.3%. That's its worst daily performance in 3 months. You have, as you pointed out, Kaylee, those lower oil prices certainly weighing on things, but it's not just oil, it's earnings as well. So this is Siemens Energy, their renewable energy company. Their shares down 8.5% because that commodity picture of rising prices is really weighing on their earnings, giving a warning today that their profits will be crimped because of those higher prices. So guys, whether inflation is transitory or not, it in real time is affecting companies and their profits. So that means what we seek in this market are safe havens. So this is the dollar versus the Swiss franc. It's red because the dollar is lower versus the franc outperforming, which of course is a haven currency. Francine, of course, we always have to explain these pairs when the dollar is in front because that's what Matt Miller would do if he was here. So I will too.
Matt Miller. Yeah, always with us in spirit. Danny, I don't know what you started. I have like 4 traders, like 3 analysts saying, where's my 8% increase? And I am told by reliable sources that the mood, indeed, at BlackRock is pretty buoyant this morning after that.
They have to wait until September, Francine. It's September when they get it.
There you go, after the summer months, so that they get back to work in full swing, especially if they're here in Europe. Now, this is what else we're looking at today. First of all, coming up, this is at 7:30 a.m. Eastern Time. Morgan Stanley reports earnings that follows results from major Wall Street rivals that have failed to excite investors. Then at 9:30 a.m. Eastern Time, it's day 2 of the Fed Chair Jay Powell's congressional testimony. This time, he's out before the Senate Banking Committee. And then a little bit later on, also the German Chancellor Angela Merkel, we know, heads to the White House for a meeting with President Biden. Tensions over Nord Stream 2 pipeline will probably certainly be on the agenda, as is travel from Europe to the U.S. But first, let's get to the data out of China. It's central to the price action and recovery story today. Second quarter GDP slowing as expected, an upside surprise for June retail sales. So to talk about this is our chief Asia economics correspondent, Enda Curran. Enda, I guess what the market is also looking at after the wobble of PBOC needing or saying that the economy maybe needed a bit of extra support is that now it seems to be steadying.
Yeah, exactly, Francine. A clear upside surprise on the key numbers today, and that will certainly calm down fears about whether or not China's recovery was slowing more than expected. You mentioned GDP for the second quarter came in around 7.9%, just below expectations. But the big takeaway was the numbers for June. We saw upside surprises for investment, for industrial output, and of course retail sales. And that was the key one to look at because retail sales has been the missing part of the jigsaw so far. We saw a big uptick in spending on restaurants and catering, for example. That does suggest consumers are finally getting out and about more. We know that the trade side of things continues. Exports remain strong. I guess the question is, how long can these good figures remain? There's an expectation now that activity will slow over coming months, especially on the trade side, and that perhaps consumers might pull in their horns too. So the numbers are pretty good for now. I think there's more of a question mark about where China's economy goes over the coming months.
Enda, thank you so much. Enda Curran there with the very latest on Chinese data. Let's also turn to what's happening in D.C. Angela Merkel heading to the White House for a meeting with Joe Biden later today. Some key transatlantic differences remain, and that's mainly on Nord Stream 2 pipeline and, of course, on travel to and from Europe. Our Bloomberg White House correspondent Anne-Marie Hordern joins us now from D.C. Anne-Marie, so good to speak to you. What will be the more thorny issue? I mean, I guess on Nord Stream 2 it will be difficult to see the two leaders see eye to eye.
Yeah, and we're just hearing now, Francine, that there will be no concrete decision regarding Nord Stream 2 from this visit with Angela Merkel. You know, the past few weeks, we've seen a lot of German officials come through Washington. I spoke with Altmaier, who is a confidant of Angela Merkel, the chancellor. I spoke to the finance minister, Olaf Scholz, and everyone was quite mute about what to expect on Nord Stream 2. But Secretary of State Tony Blinken said it's fait accompli. The pipeline is done. It's going to be finished by the end of August. What the Biden administration would like to get out of Germany is some sort of acknowledgement that they could try to help Ukraine in terms of economic and national security interests when it comes to Russia, because having Nord Stream 2 means less gas at some point is going to have to flow through Ukraine, which economically they really rely on those transit fees to get to Europe, and it's going to go right to the under the Baltic Sea, right to the German port. So this is something that has really bipartisan support in Washington and the Biden administration. This is going to be likely the biggest focus on this trip.
Well, Anne-Marie, while we're talking about Russia, that brings me to OPEC Plus. I'm going to ask you to put your OPEC reporter hat on as well for just a second. This deal with the UAE, what does it mean?
Basically just means that the UAE has a higher baseline. So right now under the current agreement, they're pumping some 3.2 million barrels a day. They're trying to get closer to 3.8. The UAE has spent, and ADNOC has spent billions of dollars. They have been expanding their production capacity. They now have a Murban contract. They want to flex their muscles, and they want to pump more oil and gas at this moment. It looks like they are going to get a deal. There are still background negotiations going on. I would never call an OPEC deal until we see it officially done. But the travel of direction looks like there will be some sort of agreement. I would say look to the others. If the UAE and the Emiratis are now getting a higher baseline, who's next? I can bet you that Baghdad is now also saying, well, you know what? It's time we pump a little bit more too.
Anne-Marie, never too far from an oil chart and an oil story. Thank you so much. That's Bloomberg's Anne-Marie Hordern. Now looking at Netflix, which aims to make a push beyond just movies and TV shows, Bloomberg has learned the streaming service is aiming to expand into video games, hiring former Electronic Arts and Facebook executive Mike Verdu to lead the effort. For more on Netflix, we have Alex Webb, Bloomberg opinion columnist, joining us. So Alex, are gamers really going to be willing to turn away from their EA favorites, your FIFAs, and instead sign up for Netflix to play games?
I'm not sure they're necessarily going to be turning away. It's really about ensuring that people who are already subscribed to Netflix stay subscribed to Netflix, and perhaps that other people who maybe already use e-games add it. This is a problem Netflix has had, that A, their growth in the US is starting to stagnate a little bit, and B, they are having higher churn. People are kind of seeing the shows that they want to see on Netflix and then starting to look elsewhere. Increasingly, we're seeing that you're not just competing with other companies who make films or TV, you are competing generally with other content makers. And Netflix is kind of making this explicit by making this push, by competing with Fortnite and, of course, then with Twitch, which is owned by Amazon. By the same token, we've already seen that Amazon, with Twitch, is getting into the gaming space. Apple, of course, it has Apple TV Plus, but it also has Apple Arcade, which is a subscription gaming service. Google has YouTube, also has Arcade, has Stadia. So this is a new play from Netflix, but it's something that's already playing out through the industry.
All right, Bloomberg opinion columnist Alex Webb, thank you so much. And Netflix is higher by about 2% in pre-market trading, but there are some other stocks on the move I want to point to. One of them moving to the upside is actually Blackstone. The private equity giant has reached an agreement to buy some AIG insurance and housing assets for $7.3 billion. The stock is up about 4% on that news. Another stock moving to the upside on no real tangible news is CureVac, of course, the would-be COVID-19 vaccine maker, but the stock has fallen about 14% on the week through yesterday's close, so maybe it's just a little bit of dip buying. It's up about 3.6%. To the downside, though, the original poster child for meme stock mania, the euphoria seems to be ending. GameStop lower for 3%, actually heading for its 5th down day in a row. From its most recent peak in June, Francine, the stock is down about 47%. So GameStop, maybe the Reddit traders turning a little sour on it, Francine.
Yeah, Kaylee, I feel like we need to become gamers between Netflix going into games and GameStop and all of that. We'll look into it and we'll find someone who can explain how we do gaming in the 21st century. Coming up, Matt Maley, Miller Tabak Chief Market Strategist, and then a little bit later we'll also hear from Whaley, Global Chief Investment Strategist at BlackRock Investment Institute. I don't know whether we'll talk about wage increases, but we'll certainly talk about inflation and ETFs. This is Bloomberg.
we're now in the early stages of a sustainability revolution.
The battery problem may be the biggest unsolved problem in all of technology.
Every time the United States has done great transformative things, there has been a partnership between government and the private sector.
With a willing partner to ensure competitiveness and draw in investment in the United States, Canada is going to be able to be even more ambitious.
The objective for Glasgow, first and foremost, is to keep that 1.5 degree temperature rise within reach.
The train has left the station. Investors care about it. People who work inside of corporate America care about these issues. And certainly we see that with just the broader community.
There's not enough tax in the world for private sector to pay for all of this. It's going to have to be a public-private partnership.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Inflation has increased notably and will likely remain elevated in coming months before moderating. Inflation is being temporarily boosted by base effects as the sharp pandemic-related price increases from last spring drop out of the 12-month calculation.
When we are close to the lower bound, which is a level below which interest rates really cannot go without having very negative consequences, then we must have a much more forceful and protracted or monetary policy stance that convince basically the markets of our determination, and that may even imply a moderate and temporary period of higher inflation above the target that we have.
Fed Chair Jay Powell and the Bank of Italy Governor Ignazio Visco talking inflation there. Of course, a lot of the focus on the markets is not only on inflation, but on the data coming in from China. Talking about the markets now, Matt Maley, Chief Market Strategist at Miller Tabak. Matt, thank you for joining us. A lot of focus, of course, on inflation, a lot of focus on the worries that Congress had yesterday with day one of that Jay Powell testimony. When you look at when we could find out, given all the variance and the concerns out there on growth as well, when we found out whether inflation really takes hold, is it now a problem that's been pushed back to November, December of this year?
Well, it's certainly something that Chairman Powell is trying to push back. It's so hard. It's kind of interesting because one of the things he did say yesterday was that it's basically impossible to know to judge when commodity prices which way they're going to go over the next few months and over the near term. Well, which is basically admitting he doesn't really know how inflation is going to go over the next few months. So the risk we take is that we don't shoot to the upside. I guess my point is that we've moved out of this emergency situation when this massive stimulus program that the Fed has created was needed because the economy was an emergency, the markets were an emergency, they had completely shut down, and now now we're out of that. I mean, to taper back is a lot different than raising interest rates. So I think that if they make a policy mistake, it's by letting inflation run too hot, because at some point they're going to have to snap it down very quickly. Remember back in late 2018. Yeah, sorry.
Yeah, you speak of inflation running too hot. We got some hot prints this week, and yet I'm looking at a 10-year yield at 1.3%. Does that make sense to you?
Well, I mean, it doesn't, because but the market isn't really running the show right now. It's the Fed, because they're keeping this kind of emergency level of stimulus in the marketplace, and it's artificially keeping interest rates low. I mean, I think we all know that their stimulus is the thing that's keeping these interest rates as low as they are, and that's great for a while, but we run the risk of not just overshooting and having a big problem with inflation. We also risk an asset bubble, a stock market bubble, and with the way the leverage is in the system, pricking of that bubble will be cause more problems than what to do if they didn't do anything.
So you mentioned a stock market bubble. Let's go there, Matt. You have small caps year to date now underperforming big tech. Is that going to be the way it is for the rest of the year? Do we just need to chase that FOMO FANG trade until things somehow normalize out?
Well, I mean, I don't think so. I think that we're going to return back to a move higher in interest rates, because I do think that one of the reasons that the interest rates came down was because everybody was caught off sides in a positioning situation in terms of everybody wanted to was betting on a steepening of the yield curve. Now I think a lot of that position has been unwound. As we just talked about, I mean, inflation is getting higher. The data is not getting much weaker. We've seen periods here and there where they're missing expectations, but growth is still there. So I think interest rates are going to come back and move higher. And when that happens, I think you're going to return to the value trade versus the growth trade. And you look on a technical side of things, these tech stocks are getting very, very overbought. You look at a stock like NVIDIA, which is a great company, but very, very overbought on a near-term basis. So I don't want to be chasing some of these big cap names.
Matt, would you be chasing some of the travel and leisure? Are they back now that it seems that a lot of economies are reopening and unlikely that we'll go back into a full lockdown?
Yeah, I mean, like anything else, these stocks got a little ahead of themselves, so I think they're a great opportunity to buy them on their most current weakness. I mean, they shot up in the spring and early summer here, and so they've come down a little bit. I think that's healthy. I mean, see some of these airlines starting to come down. I think that's a good opportunity because I just don't see people, especially in the airlines. The cruise lines may be a little bit tougher, but to go back to what we saw, in the winter and spring of this year, people are just not going to do it. They'll do whatever it takes to be able to get out, whether it be more vaccines or be willing to wear a mask again. That's fine, but I don't see a big lockdown again.
All right, we have to leave it there, but thank you so much for waking up early for us this morning. Matt Maley, Chief Market Strategist at Miller Tabak. This is Bloomberg.
markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons in New York with Francine Lacqua and Danny Berger in London. Matt Miller is off today. Now let's get the first word news. And South Korea is trying to move up its spot in the global space race. The country's science minister says this means launching satellites on homegrown rockets and eventually a mission to the moon.
The reason for moon exploration is because we expect it to be utilized in the future for not only national defense and the public sector, but the economic sector as well. In that sense, we believe we have to actively take part in the Artemis program in order for such cooperation to take place smoothly.
South Korea saw limits removed on its rocket development earlier this year when the U.S. lifted restrictions in a bilateral agreement. The Biden administration is extending a Trump-era halt to economic dialogue with China. Treasury Secretary Janet Yellen's team is in touch with Chinese counterparts, but there are no plans to restart high-level talks. And Fed Chair Jay Powell says it's too early to scale back aggressive support for the economy. That's what he told the House Financial Services Committee. Of course, he's back on Capitol Hill today, and we will discuss that with Wei Li of the BlackRock Investment Institute next. This is Bloomberg.
Blast off. China's first manned mission in 5 years is on its way. 2 veteran astronauts and 1 newbie are making their way to Tianyi Space Station, which means heavenly harmony. They're travelling in the Shenzhou 12 spaceship, launched by a Long Mark 2F Y12 rocket.
我们一定服从命令，听从指挥，沉着冷静，精心操作，圆满完成神舟12号载人飞行任务。
The crew members will be staying at the station for 3 months. They'll be carrying out experiments, testing equipment, maintenance, and more.
2022年完成空间站的在轨建造，建成国家太空实验室。之后，空间站将进入到应用与发展阶段。
Once completed, the space station will allow for stays of up to 6 months, just like the International Space Station. China has big ambitions for its space program. Last month, it landed a probe on Mars that carried a rover, the Zhurong. It sent 11 astronauts into space and 2 years ago sent the first spacecraft to land on the far side of the moon.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance Early Edition. I'm Francine Lack with Danny Berger in London, Katie Lyons in New York. Matt Miller is off this week. Now, a lot of the focus, of course, is on the markets. Danny, we look at China, we look at inflation, and I know you're looking also at wage pressures on the upside.
I certainly am. And look, it's this strange dichotomy where we're hearing anecdotally that there are wages are rising. Of course, BlackRock and the 8% wage increase come September is one of them. But if you look at the NFIB survey from out earlier in this week, Francine, yes, they see prices at all-time highs. Yes, they see the need for hiring, that those vacancies, that pressure at all-time highs. But yet we're not seeing that wage inflation increase yet. Joel, Francine, certainly thinks that the wage picture will be fixed once some of the unemployment benefits start to get scaled back.
Yeah, so we look at that, and what's interesting, Kaylee, is also speaking to our Laura Cooper. She actually believes that if you look at Treasury and some of the bonds, they're following dollar movement more than anything that came out of Jay Powell.
That's actually really interesting, Francine, because I've been pretty confused by the action we've seen in the bond market this week, given how hot the inflation prints are, and yet at the long end of the curve, we're actually seeing a bid. And that is true today as well. In the stock market, though, we're seeing a little bit of weakness, especially in Europe. The stock 600 is falling for a second day. Right now, it's down about 0.4%. And here in the U.S., ahead of Jay Powell on Capitol Hill day 2, as well as Morgan Stanley earnings coming up a bit later on, futures are now in negative territory, down about 5 points on S&P E-minis. The bond market, though, as I was saying, we are seeing a bid into the long end of the curve. The 10-year yield down 3 basis points, 1.31% is where we sit. And keeping an eye on oil today as well. Of course, you have more supply here in the U.S., plus the UAE looking to reach a deal on output with OPEC+. Plus more supply, not necessarily music to the oil market's ears right now. WTI crude is trading around $72 a barrel. And of course, that is weighing on the energy sector in particular, both in Europe and here in the U.S. when you look at pre-market trading. You have E&Ps like EOG Resources, ExxonMobil, each down the better part of 2%. And the energy select sector SPDR, which of course is a good gauge on how the sector as a whole will be performing come the opening bell, looks like it will indeed underperform, with that down about 0.6% in early hours. One stock moving to the upside, though, is Netflix. No longer will you just have to binge watch TV and film using the streaming service. You also, in the future, probably are going to be able to play video games, Danny. So that stock is up about 0.3%. My question is Netflix going to make its own controller? How is that going to work? You use a remote?
That's a good point, but I have to say, Kaylee, if they don't make a chess kind of game, like a Queen's Gambit kind of game, I mean, they have so much IP.
True.
I would certainly play that. I am not good at chess, but I could pretend I am with a Netflix game. Anyway, Kaylee, the chart I have is my first love. It is ETFs. I used to be an ETF reporter, so, you know, I love a good flows chart. I also want to welcome our radio listeners as well. And for our listeners who can't see this, let me describe to you what I'm looking at. It is half-year flows into U.S. ETFs. And the very last bar I have on this chart for our listeners, it is miles above all the other flows we've seen for first half of the year. This is the best half when it comes to inflows into U.S. ETFs. That's $488.5 billion going into the sector in the first half. The record for an entire year is just above $490 billion. We have almost beat a full year record, only 6 months into the year. Now, this, of course, means some soul searching for money managers. And this is what our big take is on today. I really recommend anyone go out and read it from Claire Ballantyne, talking about this soul searching that this move into ETFs is causing, Francine.
Yeah, I love ETFs. I love chess. I suck at chess. Wei Li is actually, I think, a double gold Olympic medalist in chess, and I'm not even kidding. Wei Li, yeah, Global Chief Investment Strategist at BlackRock Investment Institute, now joins us for a talk on the markets, on ETFs, and maybe chess on one side. Wei, thank you so much for joining us. First of all, what is the market actually looking at? If you look at the move in ETFs in the first 7 months of 2021, there's more inflows than there has been in the past years of 12 months. So why this attraction more and more towards ETFs?
There is an element of market risk on, and there is another element of ETFs being increasingly used to express that risk on view. So if you think about so far this year, absolutely, equity inflows is on track to smash record, making 2021 a record year for ETF flows by quite a bit of margin in comparison with previous records, as we just looked at. But at the same time, we're also in an environment where we have very strong growth dynamics, above trend growth dynamics, and coupled with supportive central bank and very negative real rate. And this is a very potent mix for risk assets to have done well and also continue doing well in our view, which is why going into the rest of the year, we are pro-risk, and that certainly has been borne out by the momentum that we have seen on the flow side as well.
Wait, how should we actually look at inflation? So 3 weeks ago, the market was freaking out because they saw a bit of inflation. Then we have a big inflation print, and actually they seem pretty cool about it. So what exactly is going on? What's the next? Is there a correction coming up that could be triggered by inflation? Or will they wait until later in the year to understand exactly how, what it means for interest rates in 2022?
We actually believe that we're entering a higher inflation regime, and it's driven by both near-term dynamics that have everything to do with restart, and also by medium-term drivers, including supply chain shifting, including central banks' target to want to drive inflation above target for sustained periods in order to make up for past misses, as well as this concept that we call fiscal dominance, which is that as debt rises, debt to GDP ratio rises, rates cannot move too high too quickly. Otherwise, we have a debt servicing issue, which is a bigger problem than rising inflation. And all of that clears the path for inflation to push higher in the medium term, which we believe is somewhat underappreciated by market, which is why we recently upgraded U.S. inflation-linked bonds at the expense of nominal bonds.
There's inflation kind of from the macro and monetary policy point of view, what it means for the Fed, and then there's what it means for companies. Siemens Energy today, ConAgra earlier this week. Companies are facing very real pricing pressures. How do you think about that when trying to make investments?
That's a very good point. Corporate margin over the years, they have really enjoyed tailwinds, including low cost production, low labor cost, as well as globalization. That trend favoring kind of the cost side of things, and interest very, very low has also supported corporate margin. But we are at a juncture where some of these strong tailwinds may be stalling or maybe even moving in reverse. So what that means for companies and what that means for earnings is really, really crucial. And I think the answer lies in being selective. We're looking for companies that can pass on these costs. We're looking for companies that can continue to grow their margin, grow their earnings despite the environment that we're in. And for example, based on that, future technology looks well positioned.
Yeah, wait, you're not the first I've heard talk about this balance sheet, this ability to pass on costs being important. But regardless of that, heading into this earnings season, we're just seeing this huge bid for big tech every time that T word, that transitory word, gets uttered by Jay Powell. How acute right now is concentration risk in these U.S. markets?
Well, as you mentioned earlier on, we have seen a lot of inflows into equity markets, and we ask ourselves this question: are some of the positions getting crowded? With regards to U.S. equity market, we have seen a lot of inflows, but not to the extent that we would be worried about too stretched positioning leading to potential correction. And when we look at the same indicator and analysis that we have done for other equity markets, Europe, for example, emerging market, for example, where positioning actually is far from being stretched. So despite the significant inflows, some of them are still making up for previous underweight, and we're not seeing flashing red signs, red lights in terms of positioning becoming too much of a concern that could lead to too much market nervousness at this juncture. But now, having said that, as we head into summer, thinner liquidity, we're increasingly hearing from clients that they watch out for that.
Wei, thank you so much. As always, Wei Li, their Global Chief Investment Strategist at BlackRock Investment Institute. Now, we'll have plenty more on inflation and some of the moves into ETFs. Also coming up, we'll hear exclusively from the Apollo co-founder and newly minted Chief Executive Officer. He's Mark Rowan, and he shares his vision for the investing powerhouse next. This is Bloomberg.
estava há ano sem se apresentar, as escolas estão começando a reabrir, os teatros não vão reabrir tão cedo. Aí a gente teve a ideia, no melhor estilo do Milton Nascimento, vamos levar a música aonde o povo está.
Minha missão hoje é fazer as pessoas sorrirem, cara. Sorrirem, olharem da janela, verem uma coisa inusitada, ficarem felizes, mandarem para os amigos e, enfim, curtirem um momento diferente, mesmo dentro de casa.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Farrow, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
It was definitely a noisy year, but it's interesting. I did a little bit of a year in review for our largest investors, and I said, all right, let me characterize the last year the way I would. Assets under management up 146 billion, record profits, 92 billion of deployment. We also hired 300 people remotely, from 1,300 people to 1,700 people, and turnover went down. So if I had told you that, you would have said, oh my God, really? Because the noise sometimes just exceeds the reality of what's happening. And so imagine how well we would do without noise.
Right. And yet we got to talk a little bit about the noise. The fact that you're in this job right now and sitting here talking to me as the CEO, you probably would not have anticipated a year ago. Tell me about, how the firm is doing and feeling, how you're feeling in this, post-Leon world. Josh Harris, your other co-founder, is also exiting. Help me understand what's going on.
So maybe I'll put it in perspective of the industry, at least how I see it. The industry that we are in, the alternatives industry, everyone kind of came up the same way. You have a group of firms that started life as private equity firms. If they were really good at that, they were trusted with more capital, they got to diversify. And if they were really good at that, they got to go public. But that whole generation of firms started as private partnerships with a group of founders, of which Leon was one, and the others are very well known. We will, and we are in the process of a generational shift. So we've now done the entirety of generational shift at Apollo. And that means governance, that means one share, one vote, and that also means Leon stepping down from the firm at the beginning of the year, and Josh stepping back upon the closing of the Athene deal. Now, I think every firm in our industry is going to go through this same generational shift. They likely will do it less noisily than we have, but nonetheless, we've accomplished it. So for me, this is my 36th year, 31 years at Apollo, and never had more fun.
And so what is the current effect tonally, internally, and externally of that, as you say, noisy transition and succession?
I would say it's the elimination of obstacles. So I start with, we're in a business that fortunately gets better every day. Whether we do anything positive or don't do anything positive, our business is driven by really positive forces, which makes it, we're very fortunate. So whether it is demographics, whether it is generational transfer of wealth, whether it is indexification, I know not a word, but nonetheless, of markets, or just the need for return, our business is driving forward. And while that's happening, there's some fascinating things taking place. Fintech revolution, democratization of finance, as well as just changes in the investment marketplace, which you noted in the outset. All of that is just an amazing backdrop to run and guide a firm in the alternative asset industry.
That was CEO and co-founder of Apollo Global Management, Mark Rowan, speaking there. That says the firm has seen its profit and assets under management surge to new highs during the pandemic. For more, Bloomberg's Sonali Bostic is joining us now. Sonali, obviously one of the largest alternative asset managers, and call it noise, call it what you want. It has seen a lot of turmoil this year. Where does that leave Apollo now?
It's a pretty incredible thing to see Mark Rowan speak publicly, because everybody who knows him knows that he's a man of very few words. And this is 40 minutes of an exclusive in his first time since becoming CEO of Apollo. With that said, too, he also speaks to, yes, the public perception of the firm, and also, I thought very interesting, Kaylee, their delta to Blackstone. Apollo is the biggest credit manager of its peers. Blackstone is one of the biggest private equity managers, big real estate footprint. They compete very heavily, but Blackstone has had a bigger run-up in its stock. People don't realize this, but Blackstone now is less than $15 billion in market cap away from Goldman Sachs. That's how much the private asset industry has risen in relation to the banking industry. The other thing Mark had said that I thought was interesting was that he believes their strategy will win at the end because of the lack of spread in public markets, which is why you see so many hedge funds moving to privates as well. Interesting to see how much those firms squeeze out the earnings at the end.
Sonali, we're also expecting earnings from Morgan Stanley, but the other question is actually, if you have BlackRock saying, look, your base salary will go up by 8%, that's it. I mean, not that's it, but that's as a start for everyone. Does it just push Wall Street to do the same?
We definitely see wage inflation on Wall Street almost at every level, Francine, and at the higher levels for senior bankers, senior PE managers, you're also seeing people being elevated. You know, Mark Rowan was talking about the next generation. You're seeing that happen across so many firms. Interestingly, Fran, you're hearing banking executives say their biggest competition in talent is in the investing universe, given how these markets are diverging at this period of time. So I think what BlackRock is saying is just the tip of the iceberg here.
Definitely interesting to hear how they're trying to entice people, be it a Peloton or a pay rise. Sonali, thank you so much. That's our Wall Street reporter, Sonali Bostic. Now, later today, you don't want to miss an exclusive interview with St. Louis Fed President James Bullard. That's at 8 a.m. New York time, 1 p.m. here in London. And then another Fed president later, we'll hear from Chicago's Charles Evans. That's at 11 a.m. New York time. This is Bloomberg.
Silicon Valley.
This is the global center for high technology and innovation. What happens when big tech goes unchecked?
Too much power.
They're more powerful economically, socially, politically.
Is big tech going bad?
It's all about balance.
They're not bad because they're big.
I don't think big by itself is bad.
They're bad if they violate the law and if they hurt consumers.
Bloomberg Red Lines, U.S. and Big Tech. Friday on Bloomberg Television and Bloomberg Quick Take.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
What we all need to understand, wherever you are, that if you believe that climate change is real and you know that time is short, you can't say, yes, I want to change, but just not now. Don't ask me, ask a friend. All of us have to change. So it's not an easy message, but my message to the financial system since I took over this role here is quite a severe one, because the financial system has the capacity to give us the resources to do all of this change. Firstly, by investing in what is green today, but also investing in the transition and maybe looking at some of those investments that are not sustainable and perhaps turning away from them, because we need, if you like, those three pathways. And for me then, it's how do I identify for the financial system what is economically sustainable? What am I asking of corporates, large and small, to do? And what I say in a simple way is look at our taxonomy, which does identify what is sustainable, as a management tool. So if you're not sustainable today, but you want to be in business in 20 years' time, you've got to work on the sustainability agenda.
Mairead McGuinness there of the European Commission speaking yesterday at the Bloomberg Sustainable Business Forum. And of course, this is on the back of a lot more targets and the transition to net zero by the EU. Now let's get straight to Tom Keene, co-anchor of Bloomberg Surveillance. Joining us now, Tom's looking at the zero bound and of course looking at yields in focus, Tom, but actually treasuries are not moving that much.
Well, they're moving. It's a really interesting market. We were told this would be an interesting week. Chairman Powell and others have delivered the goods. Well, first of all, we're going to drive forward the conversation this morning, Francine, an incredibly important interview. Our Michael McKee with James Bullard of the St. Louis Fed. I can't convey the importance of this interview. Bullard is the one that came out and said we would see a regime change. If a negative real yield where it is isn't a regime change, I don't know what is. It's going to be interesting to see Bullard, Powell, and the idea of a new regime. Let's go to the chart. It's a negative real yield, ever more negative. This is the residual, Francine. This is the nominal yield. Think Germany, London, the gilts, whatever. Less inflation expectations, they are ever bigger, and it gets you out to a negative real yield, which over 20, 25 years is absolutely unprecedented.
Yeah, and Tom, I have to say that when you look at dollar, I mean, it's probably one of the most interesting currencies out there, and that's probably underpinning some of all of the stock moves and bond moves that we're seeing in the U.S. I mean, what's the next thing that dollar and treasuries are looking at, apart from day two of Jay Powell?
Well, you know, the day two of Jay Powell is going to be what it is. But to your point on dollar, it's, you know, horse and cart. Is the dollar moving yield? Is yield moving dollar? I would suggest yield down. Inflation expectations are moving the U.S. dollar. And it's in the range, Francine, but it's very deceptive. Look where sterling is. And if sterling gives way at 138, that will be an important event.
Yeah, it certainly will be an important event. Tom, I'm looking forward for travels to resume and you coming back to London. Maybe we'll have a drink or two of our choices at Claridge's, depending on where dollar is. Tom Keene there, co-anchor
Got that
of
right.
Bloomberg
It's either McDonald's or
Claridge's.
Claridge's.
We're
We don't know
watching
which.
today. I know it all depends on euro dollar, or actually sterling dollar. Now, let's have a look at what else we're watching. And Kaylee, you're all over Jay Powell.
I'm watching Jay Powell again today, Francine. How hard do politicians push him once again on the impact of fiscal policy on inflation in the labor market? And how many times does he have to say fiscal policy is not in his wheelhouse, that is not his job? Also, I'm interested to see if any new words are coined today, because Alexandria Ocasio-Cortez, the Democratic representative from New York, yesterday called inflation transitionatory, which is one I have never heard before. And I'm wondering if it actually works, transitionatory, as in we're transitioning out of the pandemic economy to a post-pandemic economy.
like
Danny, does that make sense at all?
I think it does. I think the rule is, as long as you're using a T word to explain inflation, it is fair game. It doesn't matter what T word it is. And add an Ori at the end. It'll work. Well, Kaylee, I am watching OPEC Plus. They're out with their monthly oil report later today. This is going to be the first time we've gotten a monthly oil report for them where they give their outlook for the market since this tussle started to go, this back and forth between the UAE and Saudi over UAE's desire to have an increased benchmark. It looks like the UAE will get that according to Bloomberg reporting. We were talking to our Anne-Marie Hordern about this earlier. The oil market reacting here, down 0.7%. But how tight is the oil market right now in the view of OPEC Plus? That's some details we'll be getting later today, Francine.
Yeah, well, what I'm watching out for, if I ever recover from, of course, working from home and my 15th espresso, which is not better than the Bloomberg office, I'd like to tell Tom Keene, because he always says that my home coffee is so much better, is, of course, Angela Merkel in her last meeting with Joe Biden, or her last travel to the White House as chancellor as she steps down in the autumn. A lot of the talk, of course, will be on Nord Stream 2, the gas pipeline that the U.S. has opposed for such a long time. And then the other is whether EU travelers will be let in through the U.S. because of COVID. So two pretty contentious issues for the two leaders to talk about. I'll be watching that. This is Bloomberg.
Up to Maine and had a lobster. And it's not as romantic as Lisa going to Greece.
Tom Keene says what?
You mentioned Maine and the lobsters up in Maine. Well, they can't compare to what you can see in Greece. Even better, I can't pronounce it. Astercoma carinata.
I nailed it.
It's not thera, whatever. Astercoma.
You're nailing it.
Carinata.
You're nailing it.
We're figuring out the hard stuff for you on Bloomberg Surveillance. Mornings on Bloomberg Television and Radio.
On the cusp of a different economic environment where we do need to be a little more careful about inflation.
Americans were flush with cash. They didn't need to borrow, but that wears off.
Some of the strength in the consumer that we're seeing in the credit card spending data, that's going to start to shift to the business sector.
We cannot afford
higher rates. And it's very, very unlikely that we will reach the height of the last cycle.
This is going to be a very, very long expansion.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
It's Chairman Powell, day 2 from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Your equity market pulling back just a little bit on the S&P, advancing on the NASDAQ. Day 2 with Chairman Powell, Tom, and yields are lower. This curve is flatter going into that.
Yeah, the good news for Chairman Powell is Trey Hollingsworth is not going to show up. The gentleman from Indiana, John, as you mentioned earlier this morning, really with a sharp question there on the heart of the matter. What is the Fed doing to the American economy?
Well, let's paraphrase the congressman, Tom. Are we distorting the financial economy for very little benefit in the real economy?
Well, that's the question. Is it a benefit?
The short-term benefits, what are they? What are the long-term benefits of all of this? And to his point, what's the difference between $120 billion of QE, Tom, and 60 or maybe zero? They're the questions we've got to ask at the moment. And when you look at the American economy right now, I think every single data point, can you show me an example of insufficient demand? I can't find an example of insufficient demand in this economy right now. That isn't the issue, Tom.
I can't find it as well. Olivia Rodrigo moving the needle for Giuseppe Zanotti with those shoes yesterday. John, what I would look at is on the Bloomberg terminal, the U.S. 10-year inflation-adjusted yield. It's not in the textbooks. It's nothing Trey Hollingsworth studied at Penn. It's nothing that Chairman Powell's ever seen. Yes, it is a distorted economy.
How did you squeeze Olivia Rodrigo into that answer?
I had to.
Where did that come from?
Oh, come on. The song is great, John. Just go with it.
Okay, I'm going with it. Lisa, 10s, 132.
You know, to me, the biggest takeaway from yesterday's testimony, and what I'm looking for today with Powell, is his addressing what's the bigger financial risk, allowing markets to run as hot as they are, particularly the housing market, or perhaps basically curtailing this and stymieing the economy. And that really is the tension here, because right now there's no need for them to be supporting the economy more, but they do want to prevent a market's tantrum. And that really is the ultimate question.
Well, the questions that were asked yesterday, I think, are really important. You're jeopardizing your long-term objectives here, which is the question we've been asking repeatedly through the week. Are you risking this cycle being overwhelmed by things that you can prevent? And Tom, they're the questions that will come up in the Senate a little bit later.
Well, they're going to come up in the Senate. We'll have coverage of that, of course, all of our Bloomberg platforms. But, John, the answer is the Fed has a plan, and it appears, as Mr. Powell said yesterday, we're going to stick to the plan. I thought the Congresswoman from Missouri, the former ambassador to Luxembourg, her name, I'm sorry, escapes me right now, but she was brilliant about painting out the inflation people are feeling, and yet we have guests, like, say, Jan Hatzius at Goldman Sachs, saying, don't worry about that inflation. Tell that to the constituents.
When you say the Fed has a plan, Tom, the Fed has an established reaction function. They could be overwhelmed by the incoming economic data, and that's the position that some people are taking.
Yeah, right. And Brad, thank you. Ann Wagner from Missouri is the one I mentioned. Yeah, they can be overwhelmed by facts, John. When do those facts come? Maybe not before the next meeting, but as you mentioned yesterday, they don't come in December conveniently. They may come in the autumn.
Let's check in on the price action, Tom. We could be here all day talking about this. 43.64 on the S&P. Equity futures come in about 1/10% on the S&P. Elsewhere on the NASDAQ 100, advancing about 1/3 of 1%, up 48. And Tom's been all over the Apple move over the last week or so. In fact, the last several weeks, the last couple of months, a real rally off the lows on the NASDAQ 100 and some of those big tech names as well. We'll get our teeth into that in just a moment. Outside of that, 132.40, it gets your attention in the bond market. We have a bid. Yields are lower. The curve is flatter. Going into day 2, Lisa, of Chairman Powell's testimony.
And to me, I think that is a really interesting trend. We'll be talking about it throughout the morning. Today, earnings parade continues. Q2 earnings from the banks. Morgan Stanley, the last major U.S. firm to report. I am looking at the sort of toggle between Morgan Stanley and Goldman Sachs, the battle for deal-making prowess. And so far this year, if you take a look at the share performance, Goldman Sachs is up more than 40% versus a 36% gain on Morgan Stanley. Shares a little bit lower in pre-market trading. Expect to expectations very high when it comes to investment banking revenues, profits, and beats. I'm curious how much they will give guidance that this will continue. 8:30 a.m., U.S. initial jobless claims, and we're going to expect the lowest rate of claims going back to the beginning of the pandemic, 350,000. I want clues as to what Fed Chair Jay Powell was saying yesterday, that the 5.9% headline unemployment rate belies this slack in the labor market, this weakness underneath that. Do we get any signs of that from this otherwise very noisy data? And then at 9:30 a.m., Chair Powell is going to present day 2 of his testimony, this time to the Senate Banking Committee. John, I want to pick up on what you're talking about, the flattening yield curve. To me, this is the market signaling they are increasingly concerned about a policy error. The Fed is not going to react quickly enough to curtail the inflation that you're seeing again and again with all of these prints coming in way above expectations. If that's the case, the Fed would have to hike faster and then curtail the economic cycle earlier, and that is what's leading to this flatter yield curve, a more negative real yield.
Choking off growth, that's one perspective, certainly. Lisa, thank you. Bank of England's Mr. Saunders speaking right now. The policymaker from Threadneedle Street. Withdrawing stimulus may be appropriate soon, Tom. He's reflecting on the labour market and the shrinking slag in the British labour market right now. Fact of the matter is, for many people in the UK, Tom, still hard to get a read on where we are in the labour market until we get through the rest of this story, through the rest of this year. And I think many people over on the Fed share that view.
Well, where are we with the Fed on that? I mean, I don't think we're going to hear it with Jim Bullard, with Michael McKee at 8 a.m. this morning. But John, you really wonder where those voices are, like Saunders, that are going to begin to say to Mr. Powell, let's go. We don't see it yet.
Well, removing the extreme accommodation is one thing, Tom. Positioning for rate hikes is another. And I think the reason that some Fed officials aren't quite keen on the former, even though if it's justified, they're worried that people start to run towards the latter. The sequencing of this is really important. If you start tapering, then you and I are going to have a conversation every day about liftoff. The Fed, or at least some people on the Fed, don't want that to happen.
Well, yeah, but again, it's this word tantrum. We don't want another tantrum. Everyone agrees to that. Is it feasible, with our lack of knowledge, that a central bank can accommodate a society and system without tantrum? John, that is unproven.
Tony Roth joins us now, Wilmington Trust CIO. Tony, I'll start with a simple one. Why yields lower? Why is the curve flatter?
You know, I wish I knew the answer to that question. I think Lisa had a good hypothesis. But I also think that what's important is to be able to see the forest from the trees here on the 10-year, and to take a step back from a lot of the gyrations that we've seen recently and be able to predict where is the 10-year going to be, let's say, at Labor Day or at the end of the year. And we believe the 10-year is going to be meaningfully higher as we get through the year. Inflation is going to come down. Inflation is transitory, but it's not binary. It's not you're either in the transitory camp or you're in the camp that inflation is going to run very, very hot. Inflation is going to come down, but it's going to come down to a higher level than where we sat prior to the pandemic, and it's going to come down namely to the level where the Fed wants to see inflation. If you look at inflation expectations, the 5x5s or even the 10-year, inflation is going to come down to probably that 2 and 2.25%, which is not consistent with the 10-year sitting with negative real yields at over 1%. Deficit spending that we're seeing coming from the current administration and Senate caucus, Democratic Senate caucus.
Yeah.
It's not consistent with the 10-year. Real GDP, tapering, which you guys are talking about, none of that is consistent with the 10-year sitting where it is today. And most importantly, the Fed does not want a zero bound when it comes out of the cycle. The Fed wants to have a bound where it can normalize its toolkit. And so the Fed is going to look to see the 10-year move higher.
Tony,
so for all these reasons, the 10-year is going to move higher.
We've heard these arguments for a long time, and this is sort of what I'm struck by, that again and again people have pointed to these reasons, and yet again and again we see the 10-year yield go even lower. How do you counteract this argument that basically the high debt load, the fact that potentially the inflation that we're seeing now will stymie growth, is going to lead to a lower growth trajectory that the Fed really can't affect at this point?
Well, I think that, again, the market is driven right now in terms of the 10-year by a lot of institutional trading, a lot of momentum trading, a lot of technical trading. And so there's a fundamental disconnect between real yields and the fundamental economic factors that are going to drive the economy as we move forward. And I think that as investors, as long-term investors, what's important is to focus on when fundamentals will potentially take hold again. And we think that fundamentals will have to take hold as we move into a cycle where the Fed finds it necessary to taper. Whether that is accompanied with a tantrum or not, we'll have to see. But I think it's pretty clear that whether it be the September meeting, whether it be Jackson Hole, the Fed is going to have to frontally address the tapering need. And by the way, ironically, the fact that 10-year yields are so low makes it easier for the Fed to lean into tapering.
Tony, just quickly, where do you want to sit right now in this equity market? NASDAQ had a fantastic run off the March lows. We're up more than 20% since then. Small cap starting to lag. Do you want to lean the other way?
Yeah, I think you do want to lean the other way. I think you want to lean into cyclicals around this notion that the 10-year is going to be moving higher. You want to lean into stocks and into specific companies like PepsiCo that are going to be economically sensitive and that are going to show that they can increase their productivity and that they can pass on pricing to the consumer because of their brand, because of their pricing power, et cetera. And it's not sector by sector, it's company by company. Because you're going to find that there are companies, even in some of the sectors that we don't favor, like consumer staples, just gave you a great example, that are going to do really well in this environment due to their ability to execute and their underlying franchise. And it's going to happen across the entire economy. So overall, we want to be in cyclicals. We don't want to underweight technology. We want to be market weight technology. You don't want to overweight technology, because when you look at metrics like price to revenue, you're at levels that are higher than the tech bubble 20 years ago. So you don't want to be too ambitious with technology right now. You don't want to underweight it, because you can't. You just can't underweight technology, but you need to lean into the cyclical trade.
Tony, good to catch up. Tony Roth of Wilmington Trust, the CIO. Tom, just pricing power just keeps coming up again and again and again. That's where you want to be.
And revenue build.
And consumer price tolerance. All of the above. Coming up in the next hour on that story, Seb Page of T. Rowe Price from New York City for our audience worldwide. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. Federal Reserve Chair Jerome Powell says it's too early to scale back the Fed's aggressive support for the economy. He told the House Financial Services Committee the debate over bond buying will continue at the central bank's upcoming meetings. Meanwhile, Powell said that inflation has risen faster than expected. He's back on Capitol Hill today. Senate Democrats have found a way to help pay for their $3.5 trillion tax and spending legislation. Bloomberg's learned that they want to impose tariffs on carbon-intensive imports. The plan also includes expanding tax credits for renewable energy and electric vehicles. In China, economic growth steadied in the second quarter. GDP expanded 7.9% from a year earlier. That's down from more than 18% in the first quarter, a number that was skewed by the pandemic. Retail spending and industrial output both beat estimates last month. And British Prime Minister Boris Johnson will set out his vision for improving living standards today. Johnson will say that his promise to level up the country is not simply to transfer wealth from richer to poorer parts of Britain. He'll say he wants to improve areas that have felt left behind for decades. And Netflix is making its first big move beyond TV shows and movies. It's planning to expand into video games. Netflix has hired a former top executive at Electronic Arts and